window. So I don't see a good way that this is going to.
You just got muted by accident, I think. You're muted. Yeah, you don't think there's any good way for this to end, yeah, by the looks of it?
Short of him just leaving, no, I don't. That's kind of been my advice the entire time, but like the way this keeps amping up and the things that Israel is saying, I think it is really concerning. This whole pickaxe mountain thing, and I mean, just out of military options as well.
Yeah, talking about Israel. So first, you know how you keep saying, for the U.S. to get out of the region, get out of the region. Well, today, you've got the president of another country in the region in the White House. And last week, or 2 weeks ago, you had another president of another country in the region, Syria, sitting and spending time with Trump. So it doesn't look like you guys are leaving the region anytime soon.
We can't help ourselves. Like we are addicted to it. And I don't know why, but we are.
Well, there's another report of another country trying to get a meeting with a president that's struggling, and that's Israel. You know that Netanyahu had a trip to the U.S. that got rescheduled. Then he had a Fox News interview in the morning that got rescheduled or cancelled.
All right.
And a report came out today.
Nothing we can do about it. We're just whistling on the Titanic while we're headed to World War III. But anyway, we can't control it. We can say our prayers for peace, and we can get about trying to build our lifeboat. I don't have, a long presentation tonight, but I have, we'll go over some of what we've learned. And I've got to emphasize to you, let me just get the prices. Let me see where everything goes first. I got to sign in. Okay. Railtown's in the red, of course. They want you to feel the pressure. Nixie's under $1. So I forget who that was, a good person. Trying to remember who it was that asked me about that. And I think it was 3 times. I don't remember exactly, but it was much higher than this. And you just got to remember these guys, and maybe there's good people there, I don't know, but these guys put a story together. They manipulate the headline so it sounds like, can't miss. Just remember something that we learned, or at least it popped into my head like a thunderbolt on Saturday when we went late. The only way these stocks get out of this rut is institutional buying. Just remember that. All the rest of it's noise. The stock may go up. They may manufacture a squeeze, which is fun to play if you've got the phone call coming or you've got some insight and you've got trading instincts. In other words, you're willing to buy it and it might pull back for a while. And then when it runs, you just get out and you let somebody else have the dream all the way up. You can do that. But my goal here today, several of my goals tonight. One I'll be upfront about. I want to show you why these guys from Tony, I believe Tony, I don't think he's a friend of the company or of the audience. I know that he did not find this story and he did not recommend it. He bashed it. But then, because I think that's his modus operandi, and he's just one of many of these people, he came, because there's activity, he needs audience, he gets involved. And what I'm really concerned with I don't care about Tony. What I'm really concerned with, if you guys are listening to him, you're going to miss the upside here. He's going to lead you down a primrose path. Respectfully, I don't think he has access. I don't even think he understands what he's hearing. But that's not, my opinion, that's not his goal. His goal is build the way in and then help the grim reaping combine. But that's my opinion. I could be way off. Don't know. Never talked to the dude. He came on here at some time, but it doesn't matter. It's not him. It's the message. It's the message. The point is, like many other people here, somebody sent me a text telling me that I couldn't carry Tony's jock strap. That's how mature they are. The message is all there is, why don't we get out when it doubles? I mean, these high numbers you say to hold on for. What they're trying to get you to think in your head is, oh, that's ridiculous. Oh, it's crazy. Tony, or somebody like Tony, let's not pick on Tony, sounds so reasonable. Yeah, I should just take that profit. I tried to show you yesterday, if you look at your overall portfolio, let's say over the last whenever the lockdown started, and you got sucked into those various uplifts, and then we all initially believed in the stock squeezes. I fell off the wagon probably 2 years ago, but certainly a year and a half ago. With the exception that if it's coordinated by, some offshore types, it can happen. But you've got to have the first phone call. You got to be in the first batch of phone calls, and you've got to be in touch and be willing to get out, But like that Tolstoy king said, oh, it's just a little, I think diversification. I tried to show you all of these stocks are of a piece. They have the identical chance of success and the identical risk profile. They're the same thing. Just change the name, put a manipulated story in it, and get it running. Everybody gets in. And then the people that know what they're doing, they're just taking their money out. And in the backdrop, the reaping machines, the cold combines are just slicing everything down row by row, patiently. They never run out of juice. They just keep going. They're run by robots. Just keep going. Just keep going. And we can get into it again, but I think the last two long lives, I just tried to show you that it is impossible to make money in stocks under $5, whether you're a CEO or an investor, if that company needs to raise capital. Particularly true in the United States. And if that company is doing all the manipulation stories and headlines and all that, look, the SEC doesn't look very closely. They don't care. So you're going to be fleeced. You can continue to do it, but you're going to be fleeced. The charm boys, they have one goal: keep you on your back foot, keep you thinking you're getting really good information from them. You're not. You're not. Remember, the only thing that gets these stocks under $5, you don't need to know the name, any of them, to go up is institutional buying. We learned that Saturday night. That the computer synthesized it into that one concept. Institutions don't even see these stocks. So when you're listening to the breathless 3,000, 2,000, and even further, when you're dreaming of short squeezes, I submit to you, you've got to be one of the insiders that are trying to set up a squeeze, or one of the trusted phone calls. Or you can start to learn how to read the signals from somebody. If he always comes up with an idea, get in early, let him do all the work of pumping, let others come in, and you dump. Nothing illegal about that, because you're not part of it. You're just noticing a pattern. But it's so hard to do. It's so hard to do. If you're addicted to that, why don't you wait? Put your money into Railtown. I think the total metals is absolutely a screaming buy if you need something to trade, and they're not going to do toxic financing. But why don't you just wait? If you need to scratch the itch with these things, put everything in this bucket, this, whatever you want to call it, the short squeeze bucket, the conference call buckets, the breathless space call and in the know guys buckets, every hot tip bucket, the speculative high risk junk doomed to go to zero bucket. Take all those shares you have, all of them, without exception. I can't think of a single one that you own, that I know about anyway. We all know the names. I can't think of a single one that's worth owning instead of Railtown. Can't think of a single one. Total Metals, I think, is a trade you can do to keep yourself engaged. I think it could be $1, $2, $3, but I've already told you how to do it. You get in and you get your money back when it doubles or triples, and let the rest go for the drilling program. By the way, why hasn't the drilling program started yet in Total Metals? Do you know what happened up in New York and here and on the East Coast for the last many days? Do you know why Trump is slamming Canada with tariffs? Yeah, the fires. Canada's on fire, and that's right in the heart of that forest or whatever, all those trees. That's this gold mining province. They can't get in. So that happens. The gold has been there probably since whatever happened, the Big Bang or whatever. There's some question about that now with what's being discovered, but it's not going anywhere just because there's a fire. And remember, once they can get in there, they can start drilling. It's fully paid for, and the results can come quickly, and that can make it a $1, $2, $3 stock. But anyway, the key is Railtown. That's the ridicule I get from these people that want you to look the other way. Comes down to a bunch of different things. The one that's on my mind today is the $240 target. I want to show you how it gets there. I want to show you. But again, let's focus on the initial runs. But I think however you got here, however we got here, Railtown is a stock that can transform your account. But if you get out, and remember, Tony's sidekick made fun of me and he agreed. You can trust him if you want to, just don't trust his message. She said, wait, if I can buy it, I can sell it, but you're saying I can't buy it again? Don't listen to it. Think it through. The entire float here is in strong hands. It's in strong hands. And I would say close to 3/4 of the float, 200 million shares, knows exactly what they own. Exactly what they own. And they're not selling. The other maybe quarter includes us and a few maybe wealthy people that don't quite kind of, we listen to stock twits and they say, William says there's not a quiet period, but Tony talked to the CEO and he said they're not in a quiet period. Well, I learned something yesterday, and I'm willing to admit I didn't know those legal terms. And obviously, when it's a bunch of guys in London or at Merrill Lynch or whatever, and maybe it's just because these terms changed. I don't know. We used to just call it a quiet period because it defines it. But in fact, what we learned yesterday, it's a blackout. It's a news blackout. Interestingly, if Tony asked Corey, and he may have, are you in a quiet period? Corey must answer no. Because if he answered to the affirmative, he would be giving Tony information that he's not distributing to the whole world that, oh, something's going on. So it's very strict. And I think if Tony's involved in messing with your head on that, maybe you trust him. I don't. I think he wants you nervous, hot money, looking at his popcorn stock, and you're going to miss. Again, I want to emphasize, this is not about Tony. This is not anything personal. This is about your account, and you're going to miss possibly the story, but I don't know any other one you can buy into right now that could transform your account permanently. Do you know why all those guys live well? Sly Stallone, Rod Stewart, they make current income, but they live well because of the work they did in their 20s and 30s and the money they made. Georgia Peach. Do you know who the Georgia Peach was? The Georgia Peach was Ty Cobb. He was apparently a real jerk as a human being, highly competitive, self-centered, focused. He would slide in spikes high, focused on himself and his records, but he was wealthy. He could, I don't know, I can't remember if he drank, but he could just F off the remainder of his life. Why did he get rich? Was it baseball? What was it? He certainly got money from baseball, back when $40,000-$50,000 a year, even I don't know what his salary was, $100,000 a year was a lot of money. But is that what made him rich? What made him rich and what gave him the lifestyle he led, I think through drinking and unhappiness, but it allowed him to live his lifestyle. He made an investment in Coca-Cola stock back when it was a new idea. He's called the Georgia Peach. And he didn't sell the shares. He didn't sell them. And the wealth over it stuttered and started. I've never studied the stock price of Coca-Cola, but it reached a point with the dividends that it just kept growing, and his checks would come, and he could tell the world, you know, F off. One stock investment. And you can go through many companies in American history. I think Railtown is one of those companies. But they'll come make fun of me. To be clear, we do not have enough information to fully map that out. We do have enough information. In my judgment, the stock closed at 23.5 to project that, as to me, as soon as the description changes on all these services, from SaaS developer helping developers into agentic AI orchestration layer, I think you got 10x. What's 10x? $2.50. Right now it'd be $2.35. And then you start seeing maybe a little whisper of contracts. And look, the company, despite what I heard Tony said, I don't know that he said it, so let's be clear about that. But what was alleged from people here, he's looking for revenue announcements and specific numbers. The company's never going to give you that, ever. Research is there for that. But the thing is, people out there that know what they're doing, unlike Tony, in the AI space, and they've spent a lot of time studying it, unlike Tony, but a lot like you, all of you collectively have spent a year doing deep study on AI and Railtown. Doesn't remove the risk, but you know it cold. And that doesn't mean you know everything. You know what's available to know, pretty much. Doesn't mean you don't quite understand something, not understand it. Doesn't mean that either. It just means you know it better than most people out there. And the ones trying to get you scared, you know it better than they do. And the ones giving you stupid advice like, we have to rebalance our account. And hey, look over here at AME. It's great. Don't you see the pattern? Anyway, from 235, which is 10x, and I think 235 happens, yes, I will say immediately, but if it's more accurate, very quickly, I think you get 10x very quickly. You could almost call it immediately. 20x, I can't do 235 times 2. That would be 470 a share. I think 20x comes with if everyone comes back to their desks and there's a focus on the orchestration layer and you have one institution buy. I think you get 20x, 470. And if there's an awareness that spreads around to many institutions, oh my gosh, once it breaks over 5, and perhaps with a little bit of research or with a little help from realizing that, hey, this is the critical layer. This isn't just putting a little bit something nice on board. If we don't put it on board, the bloody thing doesn't work. It's critical. Then I think you can see $25. Well, let's call it $23.50. That's 100x. 100x without a short squeeze. You're not talking about manipulation. You're not talking about why don't we put a Picasso in there. You're not talking about if we get enough people buying, compliance is going to buy everybody. None of that. Just simple industry, macro growth, micro growth, multiples. Of course, we're assuming all other things are equal, like World War III doesn't start, like OpenAI doesn't self-combust, like Oracle doesn't collapse. We're assuming those. But I showed you yesterday that ironically, or paradoxically, in that kind of collapse, it makes the orchestration layer even more critical. It makes it more important because people are going to be scrambling to make all that pell-mell build out at loss leading numbers. They want to make it profitable and cash flow. So you got 100x if it goes to $23.50. I want to show you now, the boo birds are going to make fun of it. But I want to show you, and I'm not saying in a week, and I never said May of 26 that it was happening. I did have a target of 55, but you're about to see that I'm about to tell you another target because they've ridiculed it, because they want it out of your head so they can shake you out. They want to Steve Miller you. They want to shake your tree. I don't want you to have your boat rocking. Oh, please, don't you rock my boat. Finger closed at 30 cents. I was called an idiot several weeks ago when it was $1.05, and I told you it's going to 30 cents and then 20 cents. I think 30 cents, I did some study on it. I think 30 cents has a little bit of a sticking point because of the 6 month time frame to change. They have a cap, they can change it every 6 months. I wrote and I worked on something I was going to put out on Substack on Finger, and I held back because it's brutal. Finger's going to be seller boxed. you can still exchange finger stock for more than one share of Railtown. That's not going to be the case much longer. If you own finger, you should be considering the complete liquidation of your finger position. And if you want, you're lucky, because sitting right in front of you is the opportunity to get rates of return, not based on squeeze, not based on, hey, the SEC cheated us, none of that. Based on fundamentals. Now it's a new industry, and that carries speculation with it. Nothing is smooth, as we've experienced. Everything's gone on for a year and 1.5 months, or it's getting pretty close to 14 months. So it hasn't been easy. But what I want to show you is there's a very real, and not just promising, pulling a number. There's very real chance, if you hold the stock, and again, this is a high number. It'll be further out. We got to watch it. There may be chances to, once we're up in higher numbers, there may be chances to do something on the margin. But I want to reemphasize, the float is minimal. The real kind of available shares is very small. And if institutions start buying that up, if you sell trying to day trade like these cowboys want you to, you may get out, because they say, oh, you never go broke taking a profit, or you're up at 10x. Hey, that's great, get out. You may not be able to get back in. Your portfolio, because you're now sophisticated venture capital portfolio managers, you decided to invest in 12 stocks over the last 5 years. And the typical theory is, roughly half are just going to crap out. And then maybe 2 or 3 give you plus minus a little bit, 10, 20%. But it won't, if it's up, it won't really change anything because you lost so much. And then that leaves 2 or 3 that you want to get your return on. And maybe you get 1 or 2 that give you each 50%, even 100%, which is good, but it doesn't really put you in great stead with what other things you lost. But that one that breaks out, a venture capitalist doesn't sell it. They don't take a quick profit. The whole theory is, we came into a dozen stocks wanting 10, or whatever their target is, 10, 15, 20x on our money on each one. They each have to have that ability, knowing they're high risk that it won't happen. That's why you put it in a bunch of them. And when one really outdoes it, you don't sell. You don't sell. Railtown, from a portfolio approach, is the stock you hold. You already blew up your portfolio, and you took your diversification already, and your diversification didn't work. This is the one that's surviving. Now, it's a little looking backwards, but that's how I would look at it. But I'm going to show you can get 1,000x $235 from here. $235 from here. Now, I would observe two things that could change that. One is just being completely wrong. The technology doesn't work. It blows up. I don't think that's, and the execution risk. I don't think that's a real risk, but you got to acknowledge it. The second thing, and the most real risk, I think, is Microsoft buys the company, for $50, $100 a share. And the 235 happens inside of Microsoft. I hope not. But that's what I'm going to show you today. That's my goal today, among other things. But I keep hammering it. In my judgment, Tony is not here to help you make money. Tony is here to help you stay on your back foot, need his advice, which is fine. He's offering it. As a friend of mine said, he's filling a lane. That might be true. But don't pay for listening to him by blowing up your opportunity to rescue your account. You already diversified, if you want to look at it that way. The rest of the diversification crapped out. This is the one. That's the ticket to ride. And by the time it becomes clear, and when it becomes clear, Tony's going to pat himself on the back that he called it. But my understanding is that he and it's just an understanding from the feedback I got here, that he says it's high risk. You got to wait. You got to wait for projections and revenues. This is the message that I want you to ignore. Nobody knows when the stock finally breaks. But I'll tell you what's going to cause it to break: institutional buying. Now, there may be a retail rush in there first, but institutional buying is going to pull the wheels out of the mud. The tractor that pulls the bulldozer that pulls the lorry, the big Mack truck out of the muddy ditch is institutional buying. And once that happens, he's going to be telling you that he feels comfortable and he called it, but the stock's going to be potentially 100x before he does that. Or he'll start doing it and it'll be 100x before you can get into it. And you won't be able to buy. Ironically, you will not be able to buy the position that you can buy today. Many of you have 100,000 shares. I don't know what you paid, but what it's worth today is essentially, you have a little bit more. It's essentially worth 25 grand. If this stock starts to run, let's say it goes to $10. And then let's say for the next 3, 4, 5 days, it goes up 25 cents a day. It's going up by what you paid for it every day. All right, we'll get into that. I'll go through your comments. I do want, just as a change of pace, I want to go through Jim Rickard's strategic letter. You can subscribe to it. It's at Paradigm Press, but you can go to the website here. That's how you search for it. But that's interesting. He's saying something that I've been questioning in previous lives. I've brought it up and then I started feeling embarrassed. But he says the Middle Kingdom peaks. China, that's the Middle Kingdom, is the world's second largest economy after the United States, second largest population after India, maybe, and the third largest nuclear arsenal after Russia and the United States. And after decades of double-digit GDP growth, China's economy has slowed to about 5% annually. That's still very nice. And that's above the US growth rate of 3%. That was a powerful narrative that China was going to take over the United States. The narrative is falling apart. I don't know. I don't totally agree because they've automized everything. He says China will not surpass the United States and it risks falling behind India. Well, military spending. See the chart of military spending? United States spends $954 billion, but I wonder how much it's on our fleet of four-star generals. China spends $336 billion. India spends $92 billion. Russia spends $190 billion, but they spend it wisely. Let's see if Iran is in here. It may be, but I can't see it. All right, there's a lot to read there. I'm not going to bore you with it, at least not tonight. There's a discussion about Texas oil, Spindletop. I'm trying to work on a project down there. The easy oil is gone. Yeah, this is beautiful. This is all about oil. I know all about it. I could be fascinated by it, but I'm not going to make you listen to me. The two stocks in the it's one stock he's recommending. Patterson UTI Energy, PTEN, $16 a share. So the top 5 buys: Patterson UTI, PTEN, Nove Inc. At $26. That's subsea infrastructure, pressure controlled equipment, flexible pipe system. That makes sense to me. We're going to need oil. Kinross Gold at $40. Unbelievable. Alamis Gold, $50. I met with the CEO up in Toronto. I think it was an $8 stock. Man. Diamondback Energy, $230. Again, same thing. These things start moving. It can happen to Railtown too. What you've made is an investment. You've done a lot of work on it. You don't need to be shaken out. Blue chip, Advantage, shares of ExxonMobil. I think that's right. Exxon is the best oil and gas company out there. All right. So we went through his thing. I told you we'd do it quickly. All right, let's go through your questions, and then I'll show you some of what I worked on. It's not going to be that long. I feel like there's something else I wanted to say first. Oh, you guys have been asking me about the gold company, and I promised to do some work on it, and I have been making the phone calls and all that. Here's where we stand in my judgment, how I summarize it. Unfortunately, we're in Railtown, and I don't want you to sell Railtown. So you either can do it or not do it. You don't have to. You're already in it. No pressure. But I think the thing to do, bottom line, is to send the company another $50,000 to $75,000, because that'll keep us at the table. We are there at the table. If we don't do it, it's not the end of the world. But I think what's going to happen is this private equity group who put up $1 million, we've put up about $500,000, a rough number. I think they have 2 board seats out of 3. And the guy running the company is pretty much beholden to him. So I think in essence, they control the company. That doesn't scare me. If it gets to a point where I need to fight it, I will. But I don't think we're anywhere near that. I think it's actually a very interesting situation. They've actually sought additional confirmation of the processing the material. I don't know what results they got or anything like that, but I do know that, I mean, this is all we have to go on. I do believe they've decided to move forward. So, you know, putting it together, what they found was good. I would be surprised if they're able to get the massive numbers that I've seen, but I think the numbers are going to be big, and they will be in their own right massive compared to what well, by definition, compared to how the stock is trading now. So I think the good news is the company's going to be funded, and I assume it's going to get through the pilot plant and into production. I think it should be fairly quickly. I don't know if I don't know how it's all going to be. I was meant to be on the board. I'm not. And so I probably won't be. But so I don't have a lot of input, but who knows? I might. But here's the thing. They need some short-term funding, and it's what was expressed to me. I spoke to the company. It's 50 to 70,000. I think if I were able to raise 75,000 in our little vehicle, what that would do, we're already in the good graces, but it would really stand out. Wow, we help them. Secondly, what I'm thinking is, rather than compete and trying to put together a competing financing offer, which I'm willing to do, but that'll be work and that'll be attorneys and all that. If by showing this good faith, this willingness to step up, I think what we might be able to do is co-invest. And I think that would be brilliant because we would be part of a funding that has enough behind it that we would never have to worry about running out of money. Right? Well, the urgent money. If for some reason the testing doesn't work, nobody's going to keep funding that. But I don't think that's the situation. So anyway, that's my view, and I'm working on it. I mean, if Railtown suddenly went up, that would be easy, but I know it's harder. I don't think it's critical, but I think if we don't step up, we just become part of the wallflower, and this group will razzle dazzle with an offer that'll probably, it's what they do, private equity. It'll probably cram down everybody, and the rest of the shareholders will probably go along with it. I'd like to prevent that for us. I'd like to have the optionality that, hey, we put up some money. We're there. We've been there whenever you needed us. We're ready to go. And I want to be at the table in the negotiation discussions. If there's a way just to co-invest, maybe that's the best way to do it. If it turns out that the deal is so punishing on shareholders, I'd like to come up with an alternative plan. But I don't think it'll get there because I don't have any indication that the guys doing this have that intention. It's just the generic way private equity works. I don't see any evidence that they're going to do it yet. It's just my alert on. But anyway, by funding the company this little bit, I think it'll earn us a right. I think we already have it, but it'll earn us the invited right to be in the negotiations and the plannings. I have requested a site visit, and I'm going to go, and I'm going to hopefully bring investors with me, and I'll let you know how that's going. So that's a really good progress, I think, and that's my suggested plan of action. Secondly, Total Metals, I told you what happened is a fire, so that delayed operations. And that might explain why the stock is lower. I am going to have the president and I think his title is CEO. I think the gentleman I had on before was the chairman emeritus, but I'm not positive. Anyway, I'll have the president on and we'll do an interview. And I hope to do that presently. Also on Railtown, I'm going to have an interview with Corey. I don't think it's going to be public. I don't think. I'll ask him. But I'm going to talk directly with Corey here in the near future. And I think that's good for all of us too. So let's go on with, I told you Railtown's 23.5 flat, it looks like. Nixie is 93 cents. That COSM, that guy wanted you to buy, it's down to 21. Finger is 30 cents. 30 cents. Yeah, I think Trump's going to lose the midterms. And I think it sets up all our arguments for gold and silver and the miners. It sets up probably our need to really focus on our own accounts right now. And I think that's Railtown. Um, I don't know what else to tell you, but I, I listened to, you guys won't remember a guy named Brzezinski. You know his daughter, Mika. But Brzezinski was the national security advisor for Jimmy Carter. I think the Secretary of State was trying to remember his name. He was a very anyway, it doesn't matter. But Brzezinski wrote a book on international gamemanship, and it's 20 years old. No, it's more than that. 25 years old. No, it's about 20 years old. But no, it's almost 30 years old. It's almost 30 years old. And he called for it's the great game. And he called way back then that we would have to take Ukraine because it would block Russia from having access to warm water ports to the Mediterranean. And he also said back then, to hold back China, we had to take, I'm using the word take Iran. So my point is, I'm not sure. I'm upset with Trump, but it doesn't seem to matter who we vote for. We end up at war. And it might be something to do with our national defense training all these years. It might, I really don't know what's going on, but it's very frightening. All right. I went over that. Yeah, let's just keep going. Let's go with you. Pat M. Well, all right, you guys. Fast Eddie. Afternoon, Sir William. KYP. Hey Billy, how are you? I'm good. How are you up there? And you're in 4 feet of water, and you got snow, smoke, and you got a bunch of limeys and Europeans. Anyway, I hope you're well, KYP. Quit that. Guys. Girls. That's when Inspector Clouseau. No, he doesn't say girls. He's in disguise, don't you know? And he's dressed as a woman, and there's a boom or something. And he's running out of the building. And the 2 officers are in the car. And he comes running up to the cars. Boys, am I glad to see you? Quit that. Hey, Kip. Hey, KYP. Unknown Stuntsman. Hi, Uncle Bill. Picked up. Wow. $6,035 shares. Today, going to visit a buddy who's about 55, who just had a stroke. I could only imagine he's been vaccinated. Can't listen now, going to see him. Well, I know you're not listening now. Um, our, well, I can't speak for everybody, but for many, our prayers go with him and with you. Um, 55, you can have strokes naturally. I'm not allowed on YouTube to say what I think specifically, but I think your diagnosis is very likely correct. There's a doctor, Dr. Campbell, out of the UK, and he does a very reasoned podcast. He talks about the studies, and he's been doing it for, I don't know, several years now. And he's not the only one. And if I'm wrong in attributing it to him, I apologize. But I believe um, roughly a couple of years ago, he talked about the fibrous when people passed on, they are sent to a morgue and they're studied, and these things, these growths in people's veins, and of course the media and the wish it away people just, oh, it's nothing, conspiracy theory. But he does a lot of fair study in it. And I think there was a study out of Stockholm or something, and he's pretty damning about what you're talking about did to people's bodies. I think for most of us, we probably had fewer than 2 of them, and that might be okay, but I'm not sure. I'm not sure. But the scariest thing he said, and it's why it might be true what you're thinking, is he said these symptoms that are happening to some people now are going to accumulate, and they're going to show up over 5, 6, 7 years. And I'm not sure he was the one, but the same train of thought predicted that it could lead to a scarcity of hospital beds. It's going to be so bad when it comes. It's in the back of my mind. I hope it never comes. But he very sober doctor. And so I think your assessment is probably accurate. Brimbuster, Tony De Niro, that POS, positive other speaker, that POS makes fun of you. Of course. And I don't know why the company is talking to him, but I respect the company. So it's their call. I told somebody I hope gets the message. I really think Tony, when you're talking to Tony, you're talking to my audience, which I'm not taking credit for it like me. It's us. It's all of us. And we've built this together and we've grown it. But he came in like gangbusters, negative, slamming it, didn't even know what it was, YouTuber. He misinterpreted my writings and put it out. And that's from the start. And then all of a sudden he's the wise person and he's talking. But I tell you what, I think it's a waste of time. But that doesn't matter what I think. But what it does is it gives Tony legitimacy. So when Tony, if the stock goes to $3 and Tony says to you, you should sell half, or you should sell 2/3 or a third, you're going to listen to him because he's legitimate, as if he knows something. Tony hasn't done the due diligence on Railtown you all have done. You guys have done massive due diligence, mainly because I just won't shut up. But you've done a lot of work, and I think he's done next to zero. Pat M., that jockstrap comment was probably Tony. Lots of laughs. Yeah, it could be. I don't know if he has my number, but they find your number. It's a campaign. And I admit, Pat, the other day, was it last week? The lights went out. It was late. It was suddenly hot. And I was, when I'm honest with myself, I was petrified to be caught. It's, I feel safe in the neighborhood, but to be caught on the edge now, where I lived before, I was, Mr. Chairman, Mr. Mayor, knew everybody. I don't know anybody here. To be caught without electricity, my phone was on red bar. This thing was almost to red. I was like, how am I going to make it through? So I think that panic came up, but also just the frustration, because I have the same frustrations everybody else has. But anyway, it's not like I'm perfect at talking about this. So anyway, Brenton Hodge, finger red number one, finger red number one, finger red number one, finger red number one. I'm going to hope that's we are number one rather than the middle finger. I would watch you back in the AMC days. Why is it you don't talk about XRP? Hope all is well. Well, I never, you call it the AMC days. I missed all that, but you're right. AMC was active. I missed the first volcanic explosion upward, but afterward we did talk about it. We did talk about the other one too, and I don't talk about those because they're just using retail to fill the coffer of those two companies. It's all for investment banking fees, and I don't think when you have a pool of money, I have no idea what the pool of money is, but let's say it's 20 billion, or let's say it's 2 billion. It's very hard to be a genius about investing that if you're looking for short-term payouts. You have to read the market, place your commitments, but it's going to be 5, 7, 10 years before you get the tremendous return. So it's, all the hype on them. The constant churning is working out the fails to deliver. I don't think there's going to be a short squeeze. I'm very respectful to all the people who do so much hard work on it, but I just think it's losing focus right now. But then the other question, XRP, I'm trying to remember what I've studied on it, but I have studied XRP. I like XRP, but I don't believe XRP is going to be an explosive Ripple, right? I don't think it's going to be an explosive investment return. Um, I can't go through my reasoning because it's not popping in my head exactly, and I'll try to answer it tomorrow. But I think XRP is not going to be in short supply versus high demand, which is what makes prices go up. I can't remember all the mechanism of it right now, so sorry. It'll probably pop in my head as I keep going. But my strong belief is that AI and tokens and and the agentic AI may replace some of the critical aspects of what XRP is trying to do. I think it's a $1 item, $2, $3 item all day long for a long, long time. I don't think it's going to make Bitcoin type wealth. And in fact, I'm worried that Bitcoin and all those crypto coins may be replaced. There'll always be a niche, may be replaced by tokens. The idea behind crypto is that it could be a replacement for fiat currency and in fact be money. Well, money is very difficult to define what money is. It's a unit of account. It's a store of value. It's divisible. It holds its shape or its form. It's something that you can count, and you can count on counting it. I mean, if you traded ice cubes, you wouldn't have that. And there's a couple of other things about it, but two parts in it that don't line up with being money, crypto, Bitcoin, is it doesn't hold its value. It's not a store of value in the sense of if you're buying a fleet of automobiles for your rental car business out of Germany, and you pay in Bitcoin. In Germany, they have to pay everybody and reorder things. Bitcoin could be 100,000 or it could be 25,000. That's not a store of value. That's not money. The other thing is it has to be accepted as money, which is it's not really a very clear definition, but it does. It has to be accepted as money. Crypto, I think, is 2 or 3% of world transactions. I think tokens and maybe stable coins are going to replace what crypto was trying to do, because I do think tokens fulfill all of the requirements, and maybe it's better to call it stable coin, of what money is. And I also think that if there's a scarcity of data centers and compute and mining power, it's going to go to AI. But that hasn't settled out yet. And my view is probably ill-informed. I have a lot of friends of mine who think Bitcoin's going to $1 million. But I don't think XRP is an exciting, I like it, but I just don't think XRP is something that's going to change your account. I really don't. It's more likely just to be a placeholder. And I'll try to, tomorrow, I'll try to flesh out my whole line of reasoning on Ripple and XRP. Of course, my pen's not working. more specifically. I'm one of those guys, I study it, and once I decide, then it's not in my head anymore. Brimbuster, lots of laugh, or lots of Bretton Hodge. What about the Clarity Act? Never heard of it, I don't think. The Clarity Act. There is one. And it passed. Oh, it's the Digital Asset Market Clarity Act. Is a bipartisan crypto market structure bill nearing a critical vote. Isn't this for the stable coins? It establishes a comprehensive federal framework that divides regulatory jurisdiction between Commodity Futures Trading Commission and the Securities and Exchange Commission. Look, my overall view, if Wall Street wants to put it in ETFs, they want to manipulate it. That's my overall view. Exclusive oversight over the spot market for digital commodities. See, I think it is a commodity more than a unit of account. Developer bill establishes safe harbors for decentralized finance. I love DeFi. I love that idea. But I really think if AI and agentic AI comes through, it accomplishes a lot of what crypto was trying to do. I think you're going to have decentralized finance. You're not going to need the intermediaries anymore, or not as many of them. How long is it going to take for AI and agentic AI to come up with an alternative so you don't have to pay $35 to wire $500, so you don't have to pay $39 every time your account overdraws, or on and on and on. I don't know. Consumer safeguards. It requires disclosure rules, customer fund segregation in the event of bankruptcies. Ugh. Anti-money laundering, and I will follow that. I don't know what it does for XRP, but you know what? I'm Bretton Hodge. I like that. That'll be something that I'd like to look into, and we can talk about it tomorrow. How many of the following are examples? Is Railtown more of a buy and hold or more of a hold and buy? In the great by and by. I would say, if I understand your question, I think you hold it and you add to your position. Absolutely. Down here, you should be buying more. Look, I think how many, the whole name, I think Railtown is very quickly going to be $1, then $3, then $6, $7, $13. And remember, Tony and his sidekick made fun of me with those targets. Why were they making fun if they're really like it now? I don't know. But again, Tony's the only one out there that I know is spearheading this. If there were other people, I'd use their name as well. But it's if you look at the total value of the market, the global software market. Every single piece of software you've ever used in your life, every app you use on your phone or your iPad or maybe on your TV or on your refrigerator, in your car, every single piece of software that helps you and you pay for has been written by SDK, software development kits. All of it has to be rewritten or updated with agentic AI development kits, AI development kits, ADKs. And it's trillions of dollars with a T. And it's trillions of dollars every year. So that's your gigantic market. And then you ask, well, what is the software piece of that? And I personally, I think it's much bigger than the numbers I've seen. But you get to see numbers 300 billion, 600 billion a year. I think it's bigger than that, particularly once it gets to agentic AI. But then what's the part of it that's the orchestration layer? And, you know, everybody has their different numbers, but trying to remember what I last saw, I can't remember, 160 billion or something globally. But no one knows. That's the thing. The whole thing is just a warning. It's just starting. I know it's the Big Bang. It's just starting to go out. And so the total addressable market, for all intents and purposes, is huge. And then you try to figure out, well, what does Railtown have? And how's it getting there? Well, what we know, and it was in the last press release, Railtown has moved essentially from a developing, it'll always be developing, but from a company that's been a inhaler of capital as it does its research and development and engineering. As of July 8th, they put a mark in the sand. They're commercializing. They're going to revenue. And so the resources inside of the company are now primarily focused on generating revenue. And yes, you should be adding to it. You should be adding to it. The value of that big market, and just assuming 2 or 3% or even 0.5% comes, Railtown captures it. I'm going to go through some numbers. You have such huge targets. Why wouldn't you be buying? So I would say it's a buy and hold. And if you have more money, it's a buy and hold and buy. And then we can say bye-bye to the whole messy growth, this mire we're in. How many? I'd say it's both. Yeah, I like that. E. Belanger, I dream of the day when you and Tony will simply focus on your perspectives on Railtown without involving each other. You have different approaches, both of which are interesting to hear. Well, I'm open, Eric. You tell me, do you think he is working for shareholders? And if he is, that's fine. I don't look, Eric, I'll make a deal with you. I won't use Tony's name again if I can. I think sometimes you have to. It's your question brings me in with Tony. I don't care about Tony. I have no bone to pick with Tony. It's not personal. It makes no difference to me. What bothers me Eric, I think you're a very sophisticated investor, and a very you make your assessment, and you know how to ride it out. And if you can listen to Tony and learn anything, that's good. I can't listen to him because it's another source, and I don't discourage that. But what I don't want, and what I think he's going to do, and maybe he doesn't. So let's say somebody's going to do it. When 23 million shares, whatever it actually is worth $10. Do you know how much money that is? Do you know how much these people are going to be salivating to try to churn that out of this audience? What the last time I saw it happen is when people were in GTII and Finger, which are both disasters now. But it all came in a rush that we had to go to Cosmos Health. Those guys took $35 million out of the market with a financing. That's what I'm afraid of. So it upsets me. You're saying, of course, that you want me to treat him like a gentleman. I don't think he is, but fine. Okay. I dream of a day when you and Tony will simply focus on your perspectives on Railtown without involving each other. You have different approaches, both of which are interesting to hear. Okay. That's fine. That's fine. I'm not going to say anything more. For someone who has made and continues to make their own DD, Eric says, what you both say doesn't change my opinion of the game. Exactly. I think you have the fortitude through it. I don't believe, Eric, that when the emotions start and when the stock is up and everyone is tense with what should I do, that I should wait until then to warn them what the game plan is. The game plan is going to be get that money to be hot money, get it in motion. And if you enjoy listening to Tony, go listen to Tony and stay here too, whatever. But I will tell you, it wasn't a fight I started, if that's what you mean. Right at the beginning, when I came out with this, they came on to me, and they still come on me. But I'm willing. I don't respect him, so I'm not willing to, make nice, but I'm willing to let go of it. But what I'm not willing to do is back down on my conviction that that message that I'm hearing, I don't know that it's what he's saying. That message is a threat to the wealth of the people here. And that gets me up and in a feisty mood. But if you want me to lay off of him, I think he's a complete his point of view, you must, I guess you're young maybe, but his point of view, I've tried to follow it a few times briefly. I don't find it interesting at all, but everybody has different viewpoints. Brim Master Tony Baloney wants a fight with anyone that looks for it. He wants the audience, but more than that, he wants people. Two things Tony knows. People run away from a fight, and they move away from somebody engaged in the fight. And if he can come across looking more responsible, I can blow up my own credibility by getting upset. It's just psychology. The other thing is, a fight puts someone like me, who's put a lot of effort into this, down on his level, who's put zero effort in. He's talking about AME for some reason still. Anyway, let's just move on from it. I don't care. Silver Skyrocket. Hi, William. Hi, Red Pepper. Harvest and William sent you an interview with CTO from CoreWeave. He talks over the need for orchestration, observability, and has an interesting take on the need to have a mix of GPUs to drive. That's the thing. The expensive ones, the high token burning ones, and the cheaper ones. To drive the highest value, H100 for pre-processing and the very nice for the heavy lifting. Exactly. All right, I'll look it up. Good evening, Ward Richardson says, good evening, William and RT crew. When RT stack is integrated in Rubin CPUs, it will operate with 400% more speed than what the Blackwell did. A company like LangChain that has no stack, their software will operate at about 15 to 25% more speed with the Rubin. Wow. Wow. All right. We got that done. Let me go to what I have. Let me go to what I have. I'm not ready to make nice. I'm not ready to back down. I'm not ready to make nice. All right. This is what started my recent focus on the person I'm not supposed to mention. Bill Miko, obviously in a post, somebody sent this to me. Bill Miko, obviously on X, in a post, in a comments, I believe it explains itself. This is what Bill Miko said, I think a few days ago. Railtown will be lucky to see $2.47 by 2027, if ever. Not for nothing. Literally not for nothing. I think his followers, obviously referring to me, are going to lose a lot of money. As he always says, we will find out. What's wrong? I didn't know I always say that, but what's wrong with saying we'll find out? What's wrong? Thanks, Tony. So, Eric, I respect your point of view on that, but I think Tony, Bill, and others are part of a collaboration to keep people frightened, to keep people on their toes, needing their advice. So people are going to bad stock after bad stock after bad stock. That's all I care about. I wish Tony a long, healthy life. All right. Let's go on to today's topic. Oh, I wanted to talk to you a little bit about this, and it doesn't take very long, but I think I thought I took that down. I'm sorry. We're all very complacent, and I think our world is about to be rocked. So I asked a long question, and this is of the South African. My question was, approximately 20 million barrels of oil per day came through the Persian Gulf or through the Straits until Israel and the United States bombed a country the size of Western Europe 5 months ago, killing leadership and over 100 girls. Since then, every time there has been an agreement. It has seemed to just be a stall for time in order to restart the assaults. So far, it has devolved into a tit for tat, but it could become much worse. It is obvious the United States cannot protect the rulers and economies of its allies in the Gulf. It seems one path is to escalate massively because the United States has much of its banking, seniorage, economic power on the line. So far, this has not really scared the oil markets. Roughly 100 million barrels of demand per day versus 100 million barrels per day. Oh, sorry, output. I hope it understood. But the world markets are basically balanced 100 million demand, 100 million consumed, roughly. Yet 20 million barrels per day are at risk. My understanding is Saudi Arabia is moving 7 million barrels through the Red Sea. The Emirates are shifting 2 million barrels through pipeline to, I guess it's called the Indian Ocean. And there, I couldn't remember, there's another in adaptation. The most important variable that people are missing is that somehow China's demand has fallen by 5 million barrels per day. I assume they're using their version of our SPDR. What happens to oil prices when the world realizes 100 million in demand must be reduced to 80 million or so? If I remember, or I said I remembered, Iraq is trucking oil in thousands of tankers. So anyway, the answer comes. Oil markets have absorbed a massive potential shock through a combination of rerouting, inventory draws, especially China's, demand destruction, and partial offsets. But a full realization of a sustained 15 to 20 million barrels per day net loss would likely drive significantly higher prices. And here they say potentially 120 plus barrels or more in a worst case prolonged scenario. This comes from research written by 30-year-olds, or I'm being dismissive. I think the prices go much, much higher than that. And to quote Bill Miko, quoting me, we shall see. Though not in an immediate collapse. All right, so it could go to 120 in the worst case prolonged scenario, though not an immediate collapse to 80 million barrels effective supply, not immediately. All right. They're getting their answers from the research, which is so calm. The current crop of analysts do not remember the 1970s supply shock. They're about to get it upside their iPad. Oil markets have absorbed the shock. I just read that. So the current context as of mid-July, pre-crisis baseline, global supply demand 100 million to 103 million barrels of oil per day. Roughly 20 to 21 million barrels of oil per day flowed through the Strait of Hormuz, about 20% of global seaborne trade. Disruption. Since the escalation 5 months ago, flows through Hormuz dropped sharply to about 2.7 million barrels per day at times. This is the largest supply shock in decades, larger than the 1970s crisis in scale. You know what happened in the 70s? It put Jimmy Carter out of office, and it caused Gerald Ford to come up with a goofy slogan, whip inflation now. And it caused Richard Nixon to remove the gold standard. on the US dollar. That's my opinion, but that's what I think it did. Oil went up by 4 times. I think it was in 72. I can't remember. I was very young. And then it went up, I don't know, almost 10 times from there over a longer period of time. Current Brent prices hovering around $88 to $89 a barrel, recently down from peaks earlier in the crisis. And there's volatility around the ceasefires. Markets haven't fully realized the worst because of mitigations. The adaptions and offsets you mentioned. Saudi Arabia rerouting heavily via east-west pipeline to the Red Sea at Yanbu, capacity of up to 5 to 7 million barrels per day. Actual loadings surge to records like 3.8 million barrels in March, with efforts toward higher volumes, though bottlenecks and not full replacement for Hormuz volumes. The UAE limited alternatives, more reliance on pipeline lines or longer routes, but smaller scale than Saudi Arabia. Your 2 million barrel per day shift fits partial rerouting efforts. Iraq, trucking and alternative pipelines, revived Kirkuk Benias deals to the Mediterranean. This helps some northern exports bypass Hormuz. China's demand drop, 5 million barrels per day import reduction. Yes, heavily using strategic commercial stockpiles, estimated at 1.1 to 1.4 billion barrels total, among the world's largest. They've drawn down inventories and rationed, acting as a huge buffer. This isn't permanent demand destruction, but inventory release, rebuilding later, will add demand pressure. Other factors, the IEA coordinated releases, Russian spare capacity with others, global inventory draws, and some demand reduction elsewhere, rationing, slowdowns in Asia. Cumulative losses exceeded 1.3 billion barrels by June, but buffers cushioned it. What happens if the world realizes the need to cut effective supply demand to 80 million barrels per day? A sustained net shortfall of 15 to 20 million barrels per day after partial reroutes is enormous, far beyond typical OPEC cuts or Libya-Iran past disruptions. Here's the likely progression. Short term, weeks, months. If buffers deplete further, prices spike sharply. Goldman Sachs, see, that's where they got the number. I think that's very low. But anyway, Goldman Sachs has flagged $120 per barrel risk if Hormuz stays closed. Analysts have modeled even higher numbers. That's what I think. 150 to 200 in extreme prolonged cases due to panic, tanker costs, rerouting, and insurance spikes. Refiners switch crudes, but quality mismatches and logistics cause product shortages. Gasoline, diesel, jet fuel, petrochemicals, LNG, fertilizer. Demand response. Higher prices destroy demand. Yep. Efficiency, conservation, rationing, slower economic growth, substitution. And the IEA already sees a drop in 5 million barrels per day in demand. If it does go from 100 million to 80 million, it would force aggressive destruction, recessionary effects, hitting importers hardest, Asia and Europe. It'll hit here too. Developing countries face severe welfare losses. Supply response, U.S. shale. I wouldn't count on the tight shale necessarily the way it used to be, but yes, there's plenty there. OPEC plus spare, if any, other non-Gulf ramp-ups. But it takes times and has limits. Yes, it does. Long routes around Africa costs money and delay. Red Sea risks. The Houthis could worsen Saudi reroutes. Markets would balance at much higher prices. So that's the key that finds a new balance until new supply or a resolution of the war. Not a clean 80 million barrel world, more like rationing by price and policy. Volatility will be extreme with ceasefire talks. Broader effects, inflation, recession, stock market hits, geopolitical escalation, U.S. ally protection limits evident. Bottom line, mitigations have kept prices from exploding so far. 88.80 now to a potential 120 thanks to China's SPR draw, Saudi Red Sea pivot, etc. But these buffers are finite. If tit for tat escalates or Hormuz stays impaired without major new offsets, realization of the gap triggers a painful adjustment, sharply higher prices, demand destruction, and economic strain. Resolution, ceasefire reopening the strait would reverse it quickly with inventory builds. Oil markets are resilient, but not immune to 20% supply shocks. So, I'm going to skip the question because it's just me trying to sound smart. I didn't do it on purpose, but it's a waste of your time to listen to my question. No, a full realization of the shortfall wouldn't immediately become a permanent new normal, but restoring trust in pre-crisis flows would be extremely difficult without a durable resolutions. Markets would likely stabilize at higher price levels with ongoing volatility and all the other things. Short-term and longer-term dynamics. Another MOU, would it comment? Doesn't answer that. Repeated breakdowns have eroded credibility. Passions and trust. Legitimate angers have escalated rhetoric and actions on all sides. Rebuilding trust for reliable flows requires verifiable security guarantees, which are elusive. U.S. role in guarantees. Is the U.S. going to be driven out? The U.S. maintains significant presence in the Gulf, Bahrain, Qatar, UAE, Kuwait, but there's ongoing drawdown pressure, exit of Iraq by late September 26. Allies have sometimes restricted base use over fears. Regional actors, the Saudis and the UAE, self-reliance. There's China, Russia, and Pakistan. You could get the UN in. Is this a fight the United States can't back down from? From a U.S. perspective, free navigation of the Hormuz is a core interest. That's true. Energy independence helps domestically, but global spillovers make retreat costly. Backing down risks emboldening adversaries and destabilizing allies and economies. It'd be very expensive to stay there long term. Full replacement of 15 to 20 million barrels a day is not quick or cheap. The Saudi pipeline is 5 to 7 million a day. UAE 1.5 to 2. Iraq is now trucking, but it doesn't say how much that is. And then others, Egypt could have some growth. China could finance accelerate pipelines, but it takes years. Are Iran and Saudi likely to have a pact? Unlikely in the near term, but both countries are pragmatic. Pre-China, pre-war brokered a rapprochement, not a near-term fix. You could see U.S. investment in shale ramp up and non-Gulf producers, but none of it fully offsets the Gulf in quality or volume. A realization drives structurally higher oil prices and adapted supply chains and strategies. Full pre-crisis normal requires de-escalation plus infrastructure. Trust is the hardest part. So what happens to private equity flows in the United States? Private equity flows in the U.S. energy oil sector remain active but selective, with a notable tilt toward infrastructure, midstream, LNG, and power, driven by AI demand rather than pure upstream drilling. AI tech has dominated private equity VC capital allocation in recent years because of high returns and growth narratives. But the Gulf disruptions, higher volatility, and higher oil prices and energy security needs are creating tailwinds for selective energy deployments. A wall of capital, that was my word, post Labor Day into traditional oil projects is unlikely to be massive or broad, but activity could pick up meaningfully. Maybe it'll be next year. That gives us time. There's dry powder. Private equity overall has trillions of dollars in committed but undeployed capital globally. Energy infrastructure funds have seen strong fundraising. There's a huge amount of money that once it gets moving can swamp us. So it's a good time, if we can, to get in on the ground level. And so the money will seek long duration, high return opportunities in oil and gas, particularly infrastructure and power for AI. U.S. upstream, U.S. production growth is flattening, declining in forecasts. Low prices in some scenarios and capital discipline limit aggressive drilling. Geopolitical premiums help, but break-even hurdles and oversupply concerns cap enthusiasm. It's all led by private equity. Private equity has been quiet in 25, but 26 is expected to see more deployment as dry powder needs to work and exits improve. After Labor Day, it marks a return to business inflection with clearer macro signals, potential rate environments, and ongoing Gulf volatility. Q3, Q4 could see accelerated deal making. PE firms are eyeing exits and deployments in a recovery mode for 26. Wall of capital into oil profit, not a flood into traditional shale drilling. Of course, they got burned before, but there'll be M&A, hybrid opportunities with AI, selective upstream opportunities. That's exploration. Overall deal flow rising. There's a large complacency. Yes, there are elements of complacency in the oil markets right now, and the risk of a renewed or sharper price shock remains elevated, though not guaranteed. Brent is trading around the mid to high 80s amid ceasefire talks, but buffers are depleting and the underlying disruption is unresolved. Buffers are masking the full shock. Volatility exists recently. The risk of a shock is a high probability if no resolution soon. It'll come from the depleting cushions that have been used so far. Goldman Sachs is warning, and it's too low, I think. There's amplifiers, further attacks. And shortages, panic buying, and then the broader effects like a recession and inflation. But it's not inevitable. Diplomacy is active. U.S. production provides some resilience. If resolved quickly, prices could even dip below pre-crisis on inventory rebuilds. That doesn't make sense on the face of it. Unless I'm misunderstanding that. A net assessment. Complacency is risky because the fundamentals, 20% of supply at stake, haven't changed. Markets often lag until the realization moment you mentioned earlier. Watch Hormuz flows, inventory data, ceasefire closely. Another breakdown, and there's trouble. All right, let's keep going. Oops. Now we'll get to Railtown. And what Eric is saying, I appreciate, but at the same time, if it becomes one, well, you guys have to respect each other. So my part of it is be respectful so he can, whether he means it or not, parrot the, the, I don't know what to call it, the conspiracy, the sting operation talk. And remember, he came into my audience for Railtown and pulled people out. And now it's probably grown in his maybe a little bit. I don't care. Other people should be able to talk. But what I care about is my goal is different than his. And as I can see it, I want people to view this as an investment, not as hot money, not as day trading money, not as hackneyed investment rule money. But that doesn't mean that we don't follow and pay attention and keep on top of things. And I really mean that. And that's why I got worked up. I guess to Eric, and I listened to Eric, I respect Eric. I guess to Eric, it sounds very unpleasant, one person against another, and that's just William talking about Tony again. So I'll try to limit that to the bare minimum unless there's no option. But I'll just say that over the last few sessions, I've been ridiculed for my price targets. And of course, that started at the beginning with the certain someone that I will try not to mention. When I gave targets of $10 and $15, I was ridiculed. And you know what? If you judge it on a year, 14 months, that ridicule maybe, with retrospect, I deserve it. But the key is, it's not about me. It's about what's going on at Railtown and in the market. And when I've given these high targets and I just get ridiculed without any basis, without any study, I emphasize that I have said the higher the target, the longer out. There's some variables there, but I don't make it up. I'm not just pulling the number out of my laundry basket. Let's just see here what I have to talk to you about. Now, I admittedly am putting some information in here that I just didn't want to go through the whole long method of getting the computer to see it. So I said, assume Railtown is the key component in the orchestration layer on the TELUS Sovereign AI Factory with NVIDIA and the Buzz Hive BCE. What could the ARR streaming through those data centers be, say, in 2028? The rest of the question is, and what could it be for Railtown? So looking at the Canadian sovereign AI landscape, ow, 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 that hurt. That really hurt. That really, really hurt. Sorry. I have gout in my index finger. That's where it's reduced to. And wow, that was painful. Enough about me. I'm tired of talking about myself. How about you? What do you think about me? Okay, looking at the Canadian sovereign AI landscape from our current vantage point in the mid of the year 26, the hypothetical you've presented is the holy grail for an infrastructure software play. If Railtown, it's an if, here it is, if Railtown's AI agent development kit and conductor platform becomes the de facto orchestration layer across both TELUS Sovereign AI Factory and Bell Hive Buzz ecosystems, you were talking about capturing the toll booth for Canada's entire enterprise AI economy. That's a big target. Now, we don't have enough information to know this is going to happen, but we have enough indications to make it a reasonable, albeit aggressive, possible outcome. And that's all we can do. Here's how the arithmetic shakes out for 2028. I wanted it for that year and beyond. Looking at the total market flow, the take rate of the orchestration layer, and Railtown's potential slice. To understand the total AI flow, the 2028 projected annual revenue recurring, and to understand Railtown's potential revenue, we first have to size the total pie. And remember, as you're doing this arithmetic, it doesn't matter what Railtown's current share price is. It doesn't even enter into it. So double or triple or 10x of Railtown's current share price doesn't mean anything either. If you do this kind of modeling, and this is very crude because we don't have anywhere near perfect information. But if this comes up with higher targets, then whether the stock doubles, triples, 10x's, 20x's. Does not mean that the company, the stock share or the enterprise value reflects full value. This is not hot money. This is not trading advice money, in my judgment. All right, so let's break it down in these data centers. The revenue flowing through these data centers, top line, will be massive, will be massive. The BCE, Bell, Hive, Buzz, we don't know that this is happening. We've just gotten a lot of signals posted, particularly on LinkedIn, that it is. So again, that this is an assumption. But let's see what this exercise leads us to. BCE has publicly raised its target, expecting to generate roughly $2 billion in revenue from its AI-powered enterprise solutions by 2028. This is driven by their Bell AI Fabric and deep partnerships with Buzz HPC scalable compute infrastructure. $2 billion. The TELUS Sovereign AI Factory. TELUS is aggressively rolling out its NVIDIA-powered supercomputing infrastructure featuring high-density H200 GPUs. Given their enterprise footprint and race for parity with Bell, we can comfortably model a similar trajectory of $1.5 to $2 billion in AI-driven ARR by 2028. Again, these are models. Models are projections. Models are essentially a thesis. They are something that a theory you posit, and you always subject it to tests as you get more knowledge. But just because we don't have full knowledge, we've got a lot of indications. And it would be sloppy and it would be venture capital like to ignore these models and just say, oh, well, we'll wait and see. That's not how it works. So the total ecosystem from those two, TELUS and the Buzz Hive, in annual recurring revenue by 2028, the combined top line ARR flowing through these two sovereign stacks will realistically sit between $3.5 billion and $4 billion. $3.5 billion to $4 billion. It's Canadian, but I'm not going to keep pointing out whether it's Canadian or US. It's all an estimate anyway, so let's just get the ballpark. By 2028, $3.5 billion to $4 billion flowing through those data centers. So what is the orchestration layer premium? In cloud and AI infrastructure, compute is the commodity. Orchestration is the lock-in. The orchestration layer, which manages data pipelines, routes LLM queries, handles complex agentic workflows, and provides observability. The orchestration layer is where enterprise value is actually realized. Wow, sounds pretty important. What does a critical piece of the stack command? Looking at historical industry comps like Databricks, Snowflake, and Datadog in traditional cloud, the data orchestration and observability layers typically command an infrastructure attach rate or a take rate of 5 to 12% of total cloud spend. I personally believe, and not because I haven't asked around and studied it, I personally believe that that is low. and it might be half or a third, depending on where you take it, of what is ultimately done. So I always use 20%. I suppose you could use 15%. But as we go further in this example, I just said use 12%. I didn't expand it upward. Because generative AI and multi-AI systems are exceptionally complex, an end-to-end framework like Railtown's, handling everything from universal data ingestion for RAG to real-time agent observability, could comfortably command the mid to high end of that spectrum. I personally believe it'll be higher than this. So anyway, so what would Railtown's projected revenue be in 28? Assuming Railtown successfully positions itself, it's an assumption, as the deeply integrated default orchestration layer across both the TELUS and Bell Buzz stacks. Here's the projected ARR model for Railtown in 2028, based on a $4 billion total ecosystem. Railtown AI's projected revenue. So on a conservative basis here, and using a 4%, Railtown will make 160 million. Base case at 8%, Railtown would make 320. I'm asking them to take the bull case at 12%. That's 480 million. 480 million. I actually think the revenue here is the per split might be 20%, 17 and a half. I'm not sure we'll ever know, but it will show up eventually in models and in revenue, historic and projected. Okay, and what it says in the base, the baby bear, mama bear, and papa bear cases, the lower estimate, Railtown is an optional add-on. Enterprises bring their own frameworks half of the time. And the middle layer, the middle assumption is Railtown is the default as a white labeled orchestration engine natively bundled with the GPU compute. That's possible. And then the bull case, Railtown captures value on both infrastructure spend and highly specialized per agent transaction fees. That's my bet. That's my bet. They split the spending and they meter the tokens. That's my bet. So to hit that base or bull case, Railtown cannot just be another tool on a marketplace menu. That's how the computers see it now. You must negotiate to be the default fabric. When a Canadian enterprise spins up a node on the TELUS or Bell AI stack, Railtown's conductor and ADK must be the environment they automatically boot into. Your ultimate moat isn't just the AI models, it's the switching costs of the data pipelines and agent logic built inside your orchestration layer. So that's the first question. Let's go to the next one. There's not many today. Don't get worried. It's not going to be a marathon. So here's the next question. This is the answer. I didn't put the question or I've already erased it. Understanding how these two distinct financial mechanisms expand the total addressable revenue. Oh, my question was, do you have in here the multiple of the what is the value of the output of the data center instead of raw iron, as they call it? What is the output with the orchestration layer on it? And also, I asked about agentic AI expanding the use of the GPUs. I didn't use that exact phrasing. Understand how these two distinct financial mechanisms expand the total addressable revenue reveals where Railtown captures maximum value. Exciting. The end user versus raw compute multiplier. That's baked into top line ARR. If TELUS and Bell BCE were only selling raw GPU compute, bare metal H200 rental or raw token capacity, 4 billion in Canadian top line data center spend would require massive physical cluster scale. However, enterprise telcos do not sell bare metal. So there's the answer on that. They sell managed sovereign AI solutions. The raw compute floor, $1, for example, or maybe real, of raw GPU compute or infrastructure host capacity. The end user solution value, $3 to $5 in total enterprise contract value. When Bell or TELUS signs a $10 million enterprise contract, only 2 to 3 million represents raw compute usage. The remaining 7 to 8 is software value, data integration, security, domain tuning, platform orchestration, and Susan Lee Armstrong guarantees. Right here. This is where Railtown makes its bread. The 3.5 to 4 billion ecosystem total modeled for 2028 reflects end user solution spend, not just raw GPU hardware revenue. So it was already in those numbers. Great. That's why I asked the question. The second part of my question, the agentic multiplier, the real engine for Railtown. The agentic multiplier describes the shift from passive generative AI, one prompt equals one model response, to autonomous agent workflows, one prompt plus dozens of background tool calls, RAG retrievals, code generations, and sub-agent handoffs. So you get your traditional agentic workflow, and this is runs through. I didn't copy the rest of this. I'd rather just read it down here. Why this changes the financial math for Railtown. Inference, interaction, explosion. An agentic workflow generates 10 times to 100 times more background execution steps and tokens than a simple query. Orchestration revenue friction. Under a traditional seat-based model, software revenue remains flat regardless of usage. Under an agentic orchestration model, every automated loop, sub-agent handoff, and observability check passes through Railtown's platform, for example, Conductor. So what does it do to the updated, allowing for the agentic on the 2028 Railtown's ARR? Applying the Agenic multiplier to Railtown's take rate changes the business model from a passive infrastructure tax to an active execution engine. Now, it may not happen in 28, it may take longer, but we got to make our guesstimates somewhere. And institutional modelers will make these models much better than I can. So if you take the base case at 8%, end user multiplier, and flat attach rate, you get a 28 target here of 320 million in revenue for Railtown. If you use the bull case at 12%, end user plus early Agenic, that makes sense, early Agenic, bundled platform fee, light per agent execution usage, you get 480 million in ARR for Railtown. If you use hyper growth, 15% full Agenic acceleration, that might be too much. That might happen in 2029 and beyond. Value-based, usage-based pricing on agent calls, observability, and tool routing. 600 million in revenue. Just that revenue is 10 times what the stock's trading for today in a year. So avoid price. So the advice to Railtown, like they need our advice, avoid pricing based on raw GPU hours. If Railtown charges purely as a percentage of raw compute time, telco hardware price cuts will erode top line revenue. Instead, capture value per agent execution and work step. I think that's doing that. Charge based on orchestrated transactions. For example, active agent steps, data routing throughput, and real-time observability calls. As enterprises deploy thousands of autonomous sub-agents working 24/7, revenue scales with agent activity volume independent of hardware costs. So I expanded on this and I asked, so at 12%, which I think is low, from these two clusters, let's call it Canada, you project a possible 480, I added too many zeros, it caught me, 480 million to Railtown. How many, I didn't do that on purpose, how many countries would have to adopt Railtown in their sovereign data centers to reach 2 billion in annual revenue to Railtown? And they caught me out up here. See, they said it's not 480 billion, it's 480 million. Exactly. So to reach 2 billion in ARR at a 12% take rate, which I think is low, Railtown needs to capture 4.17 Canada equivalent sovereign AI ecosystems. So they have to go out in the world and get just over 4 additional Canada type sovereign AI ecosystems. Can they? Because Canada represents roughly 2% to 2.5% of global enterprise IT spend, the number of physical countries required is surprisingly small when targeting larger economies. The sovereign math, global equivalence. If Canada yields 480 million in annual recurring revenue for Railtown from a $4 billion sovereign data center stack, here is how other major sovereign AI markets stack up based on relative enterprise IT scale and sovereign compute investment. Canada is 1x because that's our baseline. That's 480 million. The United Kingdom is 1.5x. That's 720 million. Germany, which is a likely place from the recent announcement that Canada and Germany have decided to work together on this. It's a 2x, 960. Deutsche Telekom, Schwartz Group. In the United Kingdom, it's Vodafone, Isambard, and BT Group. And in Canada, we already have the names in our head. So if you come down to Japan, it would be 1.8 times Canada, and that's NTT, SoftBank, Sovereign AI, supercomputers. Middle East, UAE, Saudi, it's 1.5 times Canada, 720 million, and they have darn it, I can't see the rest of it. I think I used to have a phone on it. I just can't remember it. Anyway, they have their companies there. Humane, G42. And then Australia is 0.8 of Canada, 384 million. Telstra and Optus. So a realistic expansion path to $2 billion in annual recurring revenue for Railtown. Path 1, the G3 model, just 3 countries. Railtown wouldn't need a sprawling footprint across dozens of nations. Winning just 3 top-tier sovereign markets achieves the goal. Canada, they already have, we assume, in this model. United Kingdom, 720 versus Canada's 480 million revenue to Railtown. If they got the United Kingdom, it'd be 720. Germany, 960. Total AR is 2.16 billion. Another way, a different path, is a regional sovereign cluster model, 4 hubs. Instead of country by country sales, Railtown targets regional sovereign clouds. So in North America, the Canadian hub is 480 million in revenue to Railtown. In Western Europe, the United Kingdom and the Nordics, the hub is 800 million to Railtown. And they might already be in Sweden via the buzz. Middle East, the Gulf Council countries, the UAE sovereign cloud, 720 million. APAC, Japan or Australia hub, 500 million. If they were to get clusters in those 4 regions, it's conceivable they could cobble together $2.5 billion for Railtown in ARR. The multinational telco shortcut, this is scenario 3. Major global telco conglomerates own data center infrastructure across multiple nations under a single architecture, selling into one parent company. Selling into one parent company unlocks multiple country footprints instantly. For example, Deutsche Telekom Group. It operates across Germany, Central Eastern Europe, and U.S. enterprise links. If they were to sign up Vodafone Enterprise, operates across Europe, UK, and Africa. If they were, there it is, Etisalat. If they were to sign up Etisalat Group, It operates sovereign AI clusters across the Middle East, North Africa, and Eastern Europe. The strategic takeaway, the NVIDIA Trojan horse, to scale across 4 sovereign markets without needing massive global sales teams. Railtown's ultimate strategy should be becoming part of NVIDIA's sovereign AI factory blueprint. When NVIDIA sells a 500 million, 1 billion GPU cluster to a national telco, whether in Japan, Germany, or the UAE, they supply the hardware and reference architectures. If Railtown's conductor and ADK are embedded as the recommended orchestration layer inside NVIDIA's sovereign AI software stack, every nation building a NVIDIA AI factory automatically deploys Railtown from day one. It sounds pretty good. So I corrected myself. I said, yeah, sorry, I meant 480 million. And so it came and added to it. If we use 480 million ARR, it becomes very clear why this thesis is so compelling. When you analyze Railtown's strategic positioning, 480 million in 2028 from Canada alone is not just a theoretical model. It's not just theory. It aligns directly with the real world foundational pieces being laid down right now. Why the 480 million Canada stack holds water. If we step back and evaluate Railtown's strategic moves, the thesis for capturing this exact market share in Canada is built on 3 massive catalysts. 1, the infrastructure anchors, TELUS and sovereign clouds. Railtown has already formalized collaborations with TELUS Sovereign AI Factory and network providers like Uniserve. By integrating Rail Engine, their real-time ingestion engine, Rail tracks ADK and Conductor directly into these regional GPU clusters. Railtown positions itself right at the data ingestion bottleneck where compute is converted into working enterprise agents. 2, the institutional and founder backing. Having Mike Lazaridis and Doug Fragan, the co-founders of BlackBerry, lead strategic private placements and join the board isn't just a capital raise. It is a signal of nation building intent. They built Canada's last $19 billion technology giant. Their backing gives Railtown the institutional credibility needed to land national telco and defense contracts. 3, the acquisition engine, the AIP Partnership Corp. By acquiring AIP, Railtown inherited an ecosystem network of over 180 AI solution provider affiliates, mostly in North America, but across 13 countries. This solves the chicken and egg problem for the TELUS Bell AI factories. TELUS provides the sovereign raw GPU power. Railtown provides the orchestration layer, and the 180 plus AIP affiliates build the end user corporate agents. This is all new business, by the way. This is beyond what they're doing right now. The unlocking the $2 billion global path to scale from 480 million in Canada to 2 billion globally requires roughly 4 equivalent sovereign hubs. Railtown does not need to manually pitch every enterprise in Europe or Asia. The computers don't know that yet. Let me find the rest of that. I said it wasn't going to take long. It's already 6:45, but I'll finish it. It's not, it really isn't a marathon. So, to scale from 480 million in annual recurring revenues to 2 billion for Railtown globally, you just have to get 4 times what Canada has. So you don't have to pitch to everybody. Here's how the playbook goes. Number 1, standardize on the sovereign container. Maybe, yeah. Every country from Germany to Japan to the Emirates is enacting strict data sovereignty laws requiring AI reasoning and enterprise data to stay within national borders. Railtown should package its platform into a turnkey sovereign agent appliance. When a local telco in Europe buys an NVIDIA cluster, Railtown's orchestration software should be pre-installed out of the box. Beautiful. Number 2, leverage the Middle East and global AIP network. Railtown has already begun expanding into Dubai and the Middle East alongside ecosystem partners like Buy AI. The GCC region, UAE, Saudi Arabia, is spending tens of billions on sovereign AI factories. Landing one major GCC telco instantly delivers a 1.5 multiplier compared to the Canadian market size. Wow. And 3, monetize the agentic execution loop. As discussed, pure software licensing caps your upside. To reach 2 billion in annual recurring revenue, Railtown must capture a micro fraction of every background agent run. Automated RAG retrieval and observability trace. As thousands of corporate agents execute billions of daily subtasks on sovereign clouds, Railtown's revenue scales automatically alongside sovereign compute utilization. That really sounds big. It sounds compounding. It sounds hockey stick-ish. The bottom line of 480 million annual recurring revenue capture in Canada, Railtown becomes the undisputed toll booth for Canadian enterprise AI, reaching 2 billion in that same annual recurring revenue would simply require exporting that exact same telco plus orchestration blueprint to 3 or 4 other sovereign nations or hubs to get to 2 billion. Isn't that incredible? Isn't that incredible? You're not excited by that? Railtown can get to $500 million, $2 billion in revenue. I picked 2008. The computer doesn't think that's too illogical. But if you don't agree with me, stretch it out. It might be 2029, 2030. Just remember, when it gets the revenue, it's sticky. All right, let's keep going. Next question. Here's the next question. Start with your 2.5 billion. How much revenue was Cursor doing when Elon Musk signed the contract to buy it for 60 billion? To map out this comparison, we have to look at one of the most explosive revenue ramps. And, you know, the boo birds out there, this is what I'm trying to get you guys to see. The boo birds don't see this. We don't have to name names, but if you fall for it and their trite recommendations like resizing and all that, your portfolios, you're going to miss this. It has happened and it can happen here. And until we know it won't happen, there's no reason to bail. To map out this comparison, we have to look at one of the most explosive revenue ramps in software as a solution history. When SpaceX, via its XAI subsidiary under Elon Musk, signed the agreement to acquire Anysphere, the company behind Cursor, for 60 billion in mid-June 2026. I don't think that's when they signed the original agreement. Cursor wasn't just pulling in a few hundred million. It was generating an annualized run rate of roughly 3.5 billion to 4 billion. I'm going to tell you, I researched it. We researched it together. Cursor actually was doing a run rate of around 2 billion when he first entered into the option, which was binding, I think, for 10 billion to buy the company for that price. Let's just keep going. Here's the exact revenue breakdown and why that transaction provides the ultimate playbook for Railtown's own $2.5 billion plus ARR trajectory. Now, a couple of cautions. This is AII, they can be wrong. And two, you know, just because it's printed here, you know, it's in black and white. Don't take it. We have to watch it, watch the indications. All right, here's Cursor's revenue timeline leading to the $60 billion deal. Cursor achieved the fastest application layer growth in technology history, largely driven by the explosive shift to vibe coding and background developer agents. Well, I don't know what vibe coding means, but background developer agents, that sounds like something Railtown is working very hard to perhaps get to catch on and maybe go viral. All right, January 2025, the run rate at Cursor was 100 million in annual recurring revenue. In June of 2025, the run rate of Cursor's revenue was 500 million in ARR, and they did around at 10 billion. In November of last year, the run rate was 1 billion, and they did a Series D at just under 30 billion. And in February of 26, that's when I think the agreement was actually signed. Cursor was doing 2 billion in a runway. Forward estimates. June of 26, the acquisition was signed, 3.5 to 4 billion. Look at how rapidly that ramps. The transaction multiple, what Elon Musk paid, at a $60 billion valuation, and he used stock mostly, against an annualized run rate, I think he did, of 3.5 to 4 billion, SpaceX paid an ARR of roughly 15x to 17x. But I actually think it's double that when they entered into the agreement. For a hypergrowth AI application layer platform, 15x ARR is considered a surprisingly reasonable multiple, down from 30x. That's what I think it was when he signed the deal, 30x. Seen in 2025 venture rounds. Musk and SpaceX paid for 3 core assets. They paid for distribution and the moat. Over 1 million daily active developers writing code inside the tool. Railtown's Rail Engine is the leading code tool, which we know that it's been downloaded 35,000 times. It's probably growing. I don't know what the daily active developers metric is on it. Hopefully we get to see something like that. Could it grow to 1 million? I don't know. It's built to scale. I think it is, I think it's the best in class, but I'm not an engineer. Number 2, data loop, real-time visibility into how developers write, debug, and execute code. Well, real-time describes Railtown. And then 3, the agent execution layer, moving from a simple UI wrapper to an active execution framework where background agents perform tasks automatically. Those 3 things, minus the 1 million daily active developers, almost describe Railtown. I think Railtown might even be better. Comparing Cursor to Railtown's $2.5 billion annual recurring revenue sovereign strategy, putting Cursor's $3.5 billion to $4 billion trajectory along Railtown's path to $2.5 billion reveals key operational parallels. I wish I got this computer to recognize that when they signed the deal, Cursor was only doing 2 billion run rate. But let's just go with this. The primary domain of Cursor is AI coding and software engineering. The primary domain of Railtown, although it doesn't show up in the automatic computer screens right now, is sovereign enterprise AI and multi-agent orchestration. Target consumer is, in the case of Cursor, individual developers, enterprise IT teams. Railtown's going to go after that too. But the target that we're talking about here is the sovereign telcos and sovereign enterprises, the growth engines. Cursor is more of a bottoms-up developer adoption. Railtown could become that, but Railtown is top-down infrastructure bundling, NVIDIA and telcos, which you don't need as much of a sales force. So the ARR at maturity, in this example, 3.5 to 4 billion, mid-26 versus 2.5 billion. I wish I had gotten it to understand what I was trying to do, but I didn't have time to keep going. So what's the implied market valuation? At 15 to 17x, Cursor was 60 billion, Railtown 37.5 billion to 50 billion at 15 to 20x. 37 billion to 50 billion. And out of respect to Eric, I won't mention the group that I feel is going to get you to say, well, it went from 50 million to 100 million. It went to 150 million. What's wrong with taking a profit? This is what's wrong. It could go from 50 million to 50 billion, and it could be at an accelerating pace. And you don't know it won't. Of course, we don't know for sure it will. All right, so the key takeaways. One, the multiplier applied to Railtown. If Railtown achieves $2.5 billion in annual recurring revenue by anchoring sovereign data centers across Canada, the UK, Germany, and the Gulf, applying the market standard 15 to 20x multiple yields an enterprise valuation of almost 40 billion to 50 billion. Infrastructure versus application. Cursor achieved 4 billion in ARR by capturing the developer desk. Railtown doesn't need to win every individual developer. It wins by becoming the underlying orchestration engine, rail engine conductor, embedded into the telco infrastructure that thousands of developers and enterprise agents must run on. 3, the M&A endgame. And, I'm going to show you high targets. We might get kneecapped in the sense it's possible somebody will buy them out, but we can't control that. The M&A endgame, just as SpaceX bought Cursor to secure the agentic interface for Grok, a sovereign orchestration layer pulling in 2.5 billion ARR becomes the ultimate buyout target for hyperscalers or national defense telecom conglomerates. Desperate to own the sovereign orchestration lock-in. It's huge. When evaluating the difference between when the acquisition agreement was first signed, all right, so I did ask it, the option agreement versus the definitive merger agreement, when it was exercised and signed, the ARR numbers highlight an extraordinary scaling curve. The initial option agreement was signed April 21, 2026, and Cursor was doing 2 billion to 2.5 billion in ARR. The definitive agreement was just a few months later, June 16th in 26. It was doing 3 billion to 3.5 billion, and it hit 3 billion in May. Again, these are run rates. They're the forward projections. And all right, let me go back and get that. I want to see. I think I left something off. I thought I would have double copied it, but I didn't, because I wanted to show you over here. So SpaceX, what they did was sign the right to buy Cursor for 60 billion, and then down here they exercised it. But look at the run rate when it was signed. It was doing 2 to 2.5 billion. Look at what the value of the contract was, 60 billion. With 10 billion earnest money. Must be nice. 10 billion earnest money. Must be really nice. So they signed the deal, and it was by then projected to do 4 billion. So what does it mean? At an initial option signing, April 26, 2 billion in annual recurring revenue, Elon Musk locked up the $60 billion valuation option in April. Cursor was annualizing at 2 billion, having crossed 1 billion in November 2025 and 2 billion in February this year. At that point, the contract locked in an implied multiple right here of 30x. So a definitive agreement, we already know They were doing more, and the multiple brought down to 1720x. So the takeaway, SpaceX signed the $60 billion option because they saw Cursor doubling its ARR every few months, compounding. Locking in the price tag early allowed the effective acquisition multiple to rapidly compress as Cursor's revenue caught up with valuation. So, sorry, I'm going to try to break and make a point right there. When Elon Musk signed the deal, Cursor's revenue grew from 100 million to 2 billion in run rate in I think a year and a half. It might have been less than that. That's the kind of trajectory that Railtown could have. And if you use simple rules of thumb, like, well, you doubled your money, you quadrupled your money, you don't go broke. You might regret that Railtown right now is a $50 million company. Imagine, and I'm not promising it, I'm letting the computer do some of the comparison. Admittedly, I put in some of the prompts, but it's possible that 50 million goes to 50 billion. And I just don't want you shaken out. And again, I apologize to Eric for making it a personal tiff. I'll try not to do that anymore. If it'll stick in people's head that there are people out there trying to cause fear, uncertainty, and doubt in your head. And there will be volatility. It won't go straight up. And there will be periods like, oh my gosh, why didn't I sell? It pulled back. And they're going to play on your emotions. And I don't personally think we have enough information right now to assume that this is going to happen, but it's a keen possibility. So I want to go on to the next question. Just drink a little water here. I said, okay, I assume Railtown's revenue will also be assumed to be compounding. No, absolutely. Compounding is the single most critical asset assumption underpinning the entire thesis. So why get out early? In enterprise software as a solution, sales and infrastructure, you do not reach 480 million in a single country or 2.5 billion across sovereign hubs through linear customer by customer sales. You reach it because orchestration software sits inside a compounding usage flywheel. Looking at Railtown through both an advisor and an analyst angle, here's how to think about that compounding mechanism. Here's how it works. And here's how it's valued. The three engines driving Railtown's compounding. If Railtown scales from its early foundation to hundreds of millions in annual recurring revenue by 2028, it relies on three compounding feedback loops. And I assume they're positive feedback loops. The sovereign data center footprint, more telcos, more GPU capacity, leads to the developer and affiliate network. Well, sorry, I don't know why the arrows are here. So number 2 is the developer and affiliate network. And then number 3 is the agentic execution volume. 24/7, 24/7 running sub-agents and RAG. So number 1, infrastructure compounding, data center compute growth. As telcos like TELUS, Bell, or global equivalents add more GPU clusters, for example, expanding from H100s to H200s and next-gen NVIDIA chips, total compute capacity grows what? Exponentially. Total compute capacity grows exponentially because Railtown via Rail Engine ADK and Conductor is embedded into that infrastructure. And don't forget Rail Engine. Railtown's total addressable processing capacity, Railtown's total addressable processing capacity compounds automatically with every data center expansion. Number 2, the ecosystem flywheel. This is the network effect. They're going after the SMEs with WSI. Through the acquisition of AIP Partnerships Corp and its 200 roughly network affiliates, Railtown isn't building every end user application itself. That's a brilliant point. That is a brilliant point. You've got 200 companies and their end users all building applications using Railtown and Conductor, and Railtown doesn't have to do it. Brilliant point. So every new affiliate that joins builds multi-agent workflows on top of Railtown's Conductor platform. Every enterprise customer brought in by an affiliate deploys agents that run continuously on sovereign compute. More affiliates equal more enterprise agents, higher platform utilization, and it attracts more affiliates. It's a feedback loop. They tell 2 friends, they tell 2 friends, they tell 2 friends, they tell 2 friends. It's 6 degrees of separation. Eventually they come back and one of the extra friends tells the original friend. This is brilliant. More affiliates leads to more enterprise agents, leads to higher platform utilization, and it attracts more affiliates, which leads to more affiliates, more enterprise agents. It's great. All right, number 3, consumption compounding, the net revenue retention rate, NRR. That's another one to add to your list, NRR. In traditional SaaS, high-performing companies aim for a net revenue retention of 120%. In usage-based AI infrastructure, hypergrowth leaders like Cursor or Databricks hit NRRs of 150% to 200%. Why? An enterprise might start with 10 automated agents running customer service. 6 months later, they deploy 200 agents handling supply chain, accounting, and DevOps. The revenue per enterprise customer compounds natively without needing new sales contracts. You don't need a big sales force. The revenue per enterprise customer compounds natively without needing new sales contracts. Why? Because an enterprise might start with 10 automated agents running a customer service. 6 months later, they deploy 200 agents handling other things. That is compounding, my friends. All right, monetizing the compounding curve. To ensure market valuations reflect this compounding curve, similar to how SpaceX evaluated Cursor, Railtown must align its commercial strategy around 3 operational priorities. 1, avoid cap-based, seat-based contracts. If Railtown charges a flat annual subscription fee per company, it kills the compounding effect. They're not going to do that. They've been in software for as long as Bill Gates, or almost as long. They're not going to do that. Pricing must incorporate uses-based components. For example, active agent executions, real-time event ingestion, that's the rail engine, volume via rail engine, or observability traces. 2, standardize the developer onboarding. With over 35,000 announced Railtrax ADK downloads reported, converting free open source developer adoption into paying enterprise infrastructure spend is the key operational bridge. And they're working on that. They've announced they've moved to commercialization. So their whole team, I don't know if it's their whole team, but the majority of the team is moving from R&D. There's always R&D in these companies, but you're no longer all R&D. You're now turning to commercialization. So maybe you're minority R&D and majority putting your team to work on making customers feel good about adopting. And I think that's what is ahead of you. Number 3, anchor the advisory board for sovereign scale. Surrounding the executive leadership with industry veterans who understand national scale deployments, such as former TELUS executives and Canadian innovation leaders on Railtown's advisory board. That's not true. I think he still works at TELUS. Ensures Railtown stays in the room when the multi-million-dollar sovereign cloud allocations are signed. The takeaway, compounding is not just a financial modeling convenience. It is the fundamental nature of agentic software. This isn't just pie in the sky modeling. It's fundamental to if you succeed in agentic software. When software evolves from a tool humans click to autonomous agents operating 24/7, execution volume and the ARR attached to it compounds what? Exponentially. It compounds exponentially. All right, I'm going to go on to the next question. And it is is a possible target of Railtown, all things being equal, a value approaching cursors? And I admit I should be wearing one of those white coats with the sleeves. While comparing Railtown's current state to cursor, Railtown's current state to Cursor's $60 billion trajectory, sounds like a complete white coat. Okay, they assume mad scientist projection on paper. From an institutional research and advisory standpoint, the underlying structural ambition is actually identical. To evaluate whether Railtown could ever approach Cursor's scale we have to look past today's valuation gap and compare their fundamental architecture, distribution models, and execution risks. 1, the reality check, current scale versus target scale. At least she's not saying it's a microcap, but it is. As an analyst would look at it, the starting line couldn't look any more different. The metric, Cursor was acquired at $60 billion. Railtown today, $70 million Canadian, mid-2026. The annual recurring revenue, $3 billion to $3.5 billion for Cursor at acquisition. Right now, Railtown revenue's a blip. They're starting to commercialize. Primary moat, business to consumer and business to business, bottoms up, developer viral loop, which is yet to happen with Railtown. And so what Railtown's primary moat, for all intents and purposes, there may be more, is that it's the sovereign infrastructure lock-in, telcos and governments here. I don't think it just has to be sovereign. It can be the things we talked about before, where if you're competing with the hyperscalers, you have to compete on cost, safety, or security of data, and redundancy. And that's not necessarily just a sovereign demand. And also there's the whole vertical aspect, which I assume could be important with data for defense or healthcare. And so I don't think all data has to be sovereign, and it'll be broken out maybe. And maybe that's where Conductor helps split it out in real time. Anyway, the growth multiple at acquisition for Cursor, 20x. You can't even tell what the multiple is on Railtown. So the reality check is you might not see the connection. So to reach a fraction of Cursor's target, Railtown requires an unprecedented 500x growth curve, but it's not unprecedented. Cursor did it. It's not unprecedented. The structural thesis, where the comparison actually works. Despite the massive current valuation gap, the reason this hypothesis isn't completely crazy comes down to where the software sits on the AI valuation chain. And I'm not going to read through this because I will misinterpret what it's saying. I'm going to read it down here where it explains it. Number one, both Cursor and Railtown capture the execution layer, not the model. Both capture the execution layer. Neither Cursor nor Railtown builds foundations like LLMs, OpenAI or Anthropic. They build the orchestration and environment where work gets done. Cursor owns the developer's desktop. Railtown aims to own the sovereign enterprise background agent runner. Now, let me just point out something about this first point. That's a comp. That is a comparable. If Railtown starts to ramp its revenue in a compounding way, Cursor is a comp. All right, number two, the agentic velocity arbitrage. Cursor grew from 100 million to 3 billion in annual recurring revenue in under 18 months because developers shifted from typing code to prompting background agents. If Railtown's conductor and Railtrack's ADK become the default engine for enterprise agents in sovereign data centers, they tap into that exact same usage-based compounding loop. Wow. There's a pathway. So you're saying I still have a chance. Number 3, top-down Railtown, bottom-up. So where the strategies are different, where the risk and the reward lies for Railtown is how they go to market. The cursor advantage, they didn't need permission from telcos or governments, which is what is so slow for us. They built a product so much better than VS Code that millions of engineers forced their companies to pay for it. The Railtown advantage, if it is executed, they are winning the top-down sovereign data deals, and that creates a bulletproof moat. Once a country's national telecom and defense infrastructure integrates into Railtown to meet data residency laws, enterprise customers cannot easily swap it out. This is so powerful. Once it's in there, it's hard to remove. It's expensive to remove. So is this a white coat target? If Railtown remains solely a dev tools suite sold seat by seat to Canadian enterprises, matching cursor is mathematically impossible. Exactly. However, if Railtown successfully executes its sovereign AI toll booth strategy, don't go away. We're coming right back. All right, here it is. If Railtown successfully executes its sovereign AI toll booth strategy, one, Railtown's orchestration layer perhaps is bundled into, this is not, no one knows this, I don't know it, is bundled into NVIDIA's sovereign AI factory reference architecture. 2, Telus Bell, and 3 or 4 international telcos, maybe in the Gulf or in Europe, make Conductor the default OS for their GPU nodes. 3, pricing shifts entirely to per agent execution volume. Under those specific conditions, reaching $1 billion to $2.5 billion in annual recurring revenue is no longer a fantasy. It becomes a direct mathematical consequence of sovereign cloud utilization. Wow. That's powerful. All right, next question. Next question. We know Railtown is fully funded, presumably anyway, to revenue. That's in press releases, and it's in some of the research we've done. So no more dilution. Calculate for the projection of it, for the fun of it, for the venture capitalist in me, the per share price, if you use 234 million shares fully diluted of Railtown. I'd like to see the possible share price. Taking your assumption that Railtown achieves total operational self-sustainability with zero future equity dilution, which is an assumption. I think it's reasonable, but remember, it's an assumption. Capping the capital structure at 234 million shares or thereabouts, we can calculate the exact per share price targets across our established revenue scenarios. Applying software valuation multiples 15x to 20x, not 30, 35, or 50x. Here's how the arithmetic breaks down for a venture capitalist. This is the per share price matrix. It's going to show you the girls you have fun with and the girls you bring home to mother. This is your matrix. Number one, the Canadian sovereign stack only in 2028. That's 480 million. The implied valuation just from that's just Canada. Do you see it on the number one? Using 15x. And that's 2028 using 15x. And you don't have to wait until 28 to see this. I can't give you the exact time, but here's the valuation for the Canada stack only, $30.77. The 2028 regional sovereign expansion, and it's added to number one, it totals 1.2 billion. And it gives you at 15x an implied enterprise valuation of 18 billion. That target is $76.92 a share. And then you add in the global 4-country hub footprint. And I don't know, I didn't do it in my head. Let me see. I don't know if they're adding, we'd have to go check. But basically, maybe what's happening here is each level is already assuming the 480 in it. And now that we're at the third level, we skip the 2. So anyway, however they set it up, the global 4-country hub footprint is $2.5 billion in ARR in 2028. And using 15x, that gives you an implied enterprise value of $37.5 billion. That is $160 a share. $160.26. And then if you go to cursor parity, hypergrowth, and you get $3.5 billion in revenue somehow, it's viral. The implied valuation at 15x is $52.5 billion, or $224.36 a share. $224.36 a share. I think I have to go find, I think I deleted the one that I want to show you. Next, I don't know how I did it. Yeah, all right. This one is not deleting. There we go. And did the one I just brought up delete? No, it didn't. All right, here it goes. So now if you go to 20x instead of 15x on all those scenarios, you go from $30 in just Canada to $41.03 at 20x. And if you, I forget the next one, I think it was the Gulf and the UK. You go from $76.92 per share, and this is 2028 revenue. You go to $102.56 per share. The next layer, $160.26, would increase to $213.68. And at the hyperscaler viral catching fire pace, instead of $224 0.36, you go to 20x, you get a $299.50 target per share. Now, that's the estimate in 2028. If you find that too soon, just push it out to 29 or 30. But by definition, when things catch fire and grow algorithmically, it's rapid. It's rapid. All right, let's finish it off here. So from a venture capital point of view, if Railtown is currently trading in the microcap range, which we can agree it is, the Canadian baseline, which I just showed you, which is between $31 approximately and $41 approximately a share. If Railtown only captures the Canadian telco ecosystem, TELUS and BellBuzz, achieving $480 million annual recurring revenue yields a 100x return from current levels. Let's put that in context. $100,000 investment, and we're looking at Ward. We see you, Ward. Translates to $10 million. And if you go to the second case, or it might be the third case, the $2.5 billion global sovereign case, which ranged from $160 a share approximately to $213 a share approximately. If Railtown embeds into 4 international sovereign AI factories, the share price hits triple digits, yielding a 500x return. 100,000 investment expands to 50 million. And my whole message, without making it personal, if people are giving you the message to distrust me, they're making fun of me, they're trying to get you scared, they're going to give you the tools to play in the day trading slot market, in my opinion. If you follow those tools, look at this. Just look at this. Come back to this slide. Key operational conditions required to this is a risk, to maintain zero dilution. You need high gross margins. Typically, the orchestration software layer carries 80% plus gross margins because Railtown does not bear the capital expenditure of buying GPUs. That cost sits on TELUS Bell's balance sheet. Gross margin dollars drop quickly to the bottom line. Awesome. Positive cash flow reinvestment. To avoid issuing new equity while scaling while scaling sales teams, Railtown must funnel early sovereign licensing fees directly into international go-to-market efforts. Exactly. And then finally, non-dilutive government grants and telco pre-funding. Do you hear Dr. Tom Core? Do you hear the CSIP that the application ended June 1? Do you hear Canada's AI for All? Leveraging Canadian innovation grants, the SDTC and then the NRC IRAP and telco strategic co-development capital to subsidize engineering costs. And we've got the team built for that. I would say Dr. Tom Core, because he did that exact thing, I think, to $400 million on his resume, he probably knows everybody in Canada. except for Katy Perry. Oops. All right. So then I asked, on your NVIDIA stack conclusion, what are your thoughts on the very architect of that stack for TELUS, the first sovereign data center, Zaid Atufat Shamsi, joining Railtown's advisory board? So from an analyst standpoint, what this appointment signifies, when evaluating microcap tech plays trying to wedge themselves into macro scale infrastructure, board appointments are often cosmetic. This one isn't. It's structural. This advisory board appointment is structural. Zaid Atufat Shamsi wasn't just an executive at TELUS. As director of engineering and AI factory lead, he literally designed, architected, and he put into operation Canada's premier sovereign AI cluster. The NVIDIA-powered stack ranked #1 in Canada and number 78 globally on the top 500. His appointment to Railtown's advisory board validates 3 key operational points. 1, architectural co-design. Zaid knows the exact friction points, latency bottlenecks, and middleware requirements of the TELUS AI factory because he built it. Having the architect of hardware platform stacks advising the orchestration software company means Railtown's tools, Rail Engine, Railtrax ADK, and Conductor are effectively being optimized specifically for the sovereign data center environment. And imagine the computer's idea, wasn't mine, that the key for Railtown is to be embedded in the NVIDIA sovereign stacks worldwide. Wouldn't Zaid be the man to get that done? Zaid Atufat Shamsi wasn't just an executive at TELUS. He is an executive at TELUS. I don't know why they're putting it in the past tense. He is the director of engineering and AI factory lead. He literally designed, architected, and put into operation Canada's premier sovereign AI cluster, ranked #1 in Canada. So the first thing we talked about is the architectural co-design. Secondly, the Canadian ISV connector. In official statement, Zaid highlighted that a core mission at TELUS was assembling a full stack of domestic independent software vendors to run on Canada's sovereign compute. Zaid acts as the direct bridge connecting Railtown to essentially 200 affiliates straight into the TELUS infrastructure. It validates the toll booth thesis. This is very important. Executives of Zaid's caliber, who lead teams of 150 engineers across 5 countries. Imagine how many contacts he has, how many data centers he can touch. Do not join advisory boards of microcaps for fun. It signals that he views Railtown's agentic orchestration layer as a necessary software component for enterprise workloads running on sovereign hardware. And then the strategic alignment, the sovereign dream team. Zaid's addition completes a broader pattern at Railtown. When you look at their advisory board, Railtown has systematically, depending on which word you want to use, systematically assembled the exact national policy, infrastructure, and capital playbook needed to execute a sovereign monopoly. That sounds good. There's Mike Lazaridis, the co-founder of BlackBerries and Research in Motion. He is the grandfather of Canadian tech hardware and security sovereignty. Pat Horgan, former COO of IBM Canada, knows how to sell multi-million-dollar enterprise software into government and enterprise. John Ruffalo and Michael Norbreger, founder of Council of Canadian Innovators and former CEO of OMERS, that's Mike Nobrega, the capital markets and pension/institutional policy heavyweights. And then Zaid Atufat Shamsi, telesovereign AI lead, the actual technical architect of the GPU compute layer. Absolutely amazing. Absolutely amazing. So you have the sovereign playbook, and then it comes down to all this, but let's read about it. It comes down to the technical architecture, which is Atufat Shamsi Telis. In the middle, you have enterprise and policy, Pat Horgan, and institutional capital, you have John Ruffalo, Omers, and others. And then it goes out. You also have Mike Lazaridis. But let's just read down. It should say it here. The advisor, how an advisor would perceive this. Railtown leverages Zaid in order to scale. Having Zaid on the board shifts Railtown's primary strategic initiative from product market fit to infrastructure integration velocity. Here's how Railtown must put into operation his presence. One, embed, we don't know if this will happen, but embed into NVIDIA's DGX cloud /reference architectures. It's as good a bet as any. Zaid's team built the Telis cluster on NVIDIA's reference designs. Railtown should leverage Zaid's relationships to ensure Railtown's conductor is formally certified on NVIDIA DGX Cloud and included in standard deployment blueprints for other global telcos. That's powerful. That is powerful. Number two, he was the architect for zero trust sovereign compliance. This is healthcare, financial services, and public sector clients cannot use public US cloud endpoints. Zaid's core expertise is compliance and data residency boundaries. Railtown must use his guidance to make Conductor the audit ability and observability standard for regulated industries using sovereign clouds. His presence is very powerful. And then the last point, he has to replicate the Telis template internationally. When Railtown approaches telcos in Europe, the Gulf, BT, Deutsche Telekom, Etelesat, Zaid gives them the exact blueprint. Quote, for example, here's how we integrate orchestration software into Telis's sovereign cluster in Canada. We can copy paste this architecture into your data center without all the committee meetings and approval process required in Canada. It probably will go a lot more quickly in some, not all, but some parts of the world as a template. The conclusion, bringing in the architect of Canada's first sovereign AI factory bridges the gap between theoretical software and physical data center execution. It turns the hypothesis of Railtown becoming the default orchestration layer for Telis from an investor pitch into a concrete engineering roadmap. And I'm going to save I'm going to save, he has a video explaining some of that. I'm going to save that for another time. So what I tried to show you from these series of questions is, and my whole goal is over the next few weeks, the high frequency trading complex and this whole scheme, this whole day trading, keep your emotions on edge, trade in junk manipulated stocks. You're going to get advice, and I out of respect to Eric, I'm just not going to point out where, but you're going to get advice to, if it trades up, get out or take a profit or come over to this. So one of my goals, and also they may keep the pressure on the price during the August low. I don't know. Anything's possible. But one of my goals is to give you so much information and so much of appreciation for what the upside could be. I'm not saying it's not a promise. It's a prediction, maybe. That'll take care of itself. Let's just focus on making sure you're not Steve Millard out of your position. They want to shake your tree. They want your peaches. Don't let them do it. That's the main goal. But I also want to show, because I've been ridiculed by those same people, some of them who, at least one of them apparently talks to the company and he's ridiculing me. Maybe Eric's point is right. Let's just assume the company knows what it's doing, and let's he and I do our separate strategies. But I really want you to see that this is a real company. It's mispriced. The stock is mispriced. And to just kind of use rule of thumbs, because it's 25 cents today, that, wow, if it goes to $1, you got to take some money off the table. That is as wrong, taking the money off or judging it based on its price. Those are two just ballpark guesses. They're just, you're making decisions without doing the due diligence. And everybody here, now we are a small, talented private equity or venture capital institutional desk, and we have analyzed, we've put our due diligence in, and we didn't get into this stock to get out at a double or even at 10x, in my judgment. We didn't get into it with any target at all in mind as we thought about it, other than, if we're taking risks, this is how we think as an institution. We want to make sure it can do better than 10 or 12x, because we're spread out in so many companies. We want to spread that risk. So we got to know it has upside. But then the way to figure out what your target is isn't based on where the stock price is. It's irrelevant. The way to do it is to calculate backwards. Essentially, what's the size of the market? What's the addressable market? How rapidly is it growing? What's the IP? What's their product? What's the exception? The adoption rate, and other advantages. What's the competition? And we've done all of that. We've done it. And now the company's in commercialization, and I submit to you, you're about to see two hockey sticks or two reverse ski slopes. One is in projected revenue growth, which I think is going to grow on itself or compound on itself, or compound's the right word. And the other sort of algorithmic S-curve that you're going to see is in the share price. And what you're waiting for, you're not waiting for news releases. You're not waiting for hype. There is no hype on this stock. You're not waiting for any of that. The news releases are important. It'll make you feel comfortable. But until an institution steps in to buy, the high frequency Grim Reaper combines will continue to strip mine retail ownership of this stock penny by penny, fraction of penny every single day. That's their goal. And if it runs up, they will put pressure on it downward. So we have to survive their allies during that time. Fear, uncertainty, and doubting us out, saying, William, oh, he's a liar. Oh, you made enough. Oh, are you crazy? Or like that this communication between Bill Miko and someone named Tony saying Railtown will be lucky to see 247 by the end of 27, if ever. I think his followers are going to lose a lot of money. As he always said, we will find out. Thanks, Tony. Well, this is the kind of pressure that could be coming in these volatile, not just now, but in volatile moves up and down without institutional buying, and they can shake you out of your tree. Remember, they want your peaches. They want to shake your tree. Don't let them. There is going to be volatility, and they're still going to be in there. They're the Grim Reapers. They're robotic. And that's why I speak out so much. It's not personal. It's not meant to be personal. I tend to think the specifics, being specific on where it's coming from helps people understand what I mean. But I'm willing to stop using names as almost most of the time. But the point is, as that message gets into you, what I've tried to do here today is give you a reason to hold through the volatility. What's your reward? If the stock goes from 25 cents to 50 cents, 70 cents, pulls back, don't be shaken out. If it then goes to 120 and it pulls back to 90 cents, don't be shaken out by this kind of message from Bill Miko and somebody named Tony. I don't know who. No last name. It's on X, and it's a comment chain, so we don't know. Don't be shaken out by that kind of message. Don't assume that just because they've been trying to be your guru and pretending to be on your side for a while, don't assume their motive isn't to do one thing. Get some liquidity in the market for Railtown. Railtown's publicly traded stock, in my judgment, is all in strong hands. All in strong hands. Probably 3/4 of it is in strong hands, and maybe more. We are where they can come get shares to solve their problem with failure to deliver, failure to locate, and all of the games they play. So they're going to use every guile to get you to give up. And you might think, wow, lucky, I got out at $3 and now it's $1.75. Whew, aren't I smart? Well, then you're going to be amazed. It goes from $1.75 to $4.25. That's the kind of volatility. So there's two things that I keep focusing your attention on, not to get fudded. And I want to get you to think of what you really have here. You are an institution, so you've done your due diligence, and you've calculated from the top down. In other words, I'm calling it the top, from the addressable market all the way down. First, you calculated the the numerator. You know the denominator because they did not do toxic financing. So you now know what your upside could be. I think out of the 200 million shares, and this will be my closing point, out of the 200 million shares, as much as 150 million, maybe 160 million are in strong hands. When you add our 23 million, and there might be some overlap, and you add maybe the BlackBerry you got to add. So that's probably you're already at 160, 165. And if you call ours, because a lot of you don't tell me, if you call ours 25, that's 190 out of 203. I'm telling you, there is no float. Nobody is selling shares. The stock price doesn't tell you anything. Nobody is selling. They're using their same modus operandi, like they can destroy all these other stocks. But here, you're going to have revenues that blow you and them away. And therefore, they do not need to go to take any financing. And the big kryptonite, if you want to call it, the big antidote, is institutional buying. And when institutions come in to buy 5 million, 10 million, 20 million shares, where are they going to get the stock? I think most of the shares are strongly held. Where are they going to get stock? The only place they're going to get stock is when the price meets at a true supply and demand where somebody wants to give up some of their shares. Hopefully that's a price, if you're the one selling, that you're happy with. But I would caution you, don't just sell because it hits some sort of Fibonacci number, or it hits something that those guys start telling you, you got X percent, you got to get out. Why? Remember, and you just went through the calculation. Remember what the ultimate per share price could be. We don't know all those high prices yet, but I think it certainly makes the 10, 15, 20, $25 targets, and even my long-standing $55 targets seem much more reasonable. So don't be shaken out. And anyway, I'm going to end it there. Let me see if there's any comments. There are, so I will go to the comments, but I'm going to end it there. And thank you, for listening, and try to review some of what we've been talking about. All right, let's go to the comments. Bob's. Hey, RT crew. Wow, Bob's. The Bobster. That's incredible. Added. Oh, I thought you said 4,300. You added 4,300. I'm jealous of you guys. 43,246. Unbelievable. Good for you, Bob. That's a hearty clap on the back. 600,000 now exactly. Man, probably done. My wife thinks that's enough. But at these prices, I couldn't help it. Well, I've never known somebody to come out of a TV store wishing they had purchased a smaller model. But on the other hand, only you and your wife know, your whole picture. So her advice, fair enough. But I think guys like George Soros, who made apparently his first billion on the British pound, that old saying, get a hunch, bet a bunch. I think that's what you do. There is really, at least if you, Bob, and your wife have money in some of these other names, there's nothing that beats Railtown. I mean, I think Total Metals is a way to, in a fairly short term, to double, triple your money, take original money off, and be exposed. Well, I suppose that's 10 to 30x. And that could be a source of new money for Railtown. But the timing really kind of clashes a bit with the eventual S curve, I think, that's going to happen in Railtown. On the other hand, if there's war or there's some sort of financial catastrophe, everything will go down, but gold will likely come back strongly, and it gives you a little bit of a hedge. I don't know. I'm constrained in my cash flow in this for some, I guess, toughening reason in my life, but I can't do much about it. But I think I would diversify in that. But if it's the other stocks, Bob, if it's the other stocks, get out of them and get into Railtown. I can't give, that's opinion. I can't give you specific advice. My experience is just when you say that's enough, or it's gotten too low, I don't want to overdo it, that's when you usually regret it in the future. But I tell you, 600 is fantastic. I know somebody else with 600. And what I like about 600, Bob, is at some point in the future, we don't know where, you've got 100, as Ward would call it, you've got bonus shares. And that whole 100 extra kind of gives you something to have to sell or to trade with, maybe. I think trading is going to be risky. And then you can keep a core of 500,000. But let me put it in real numbers, Bob. 600,000 shares at $10. I'll let you figure it out. That's a lot of squid. And I don't know many stocks that you have a reasonable risk reward without all this short squeeze thing and all that, where you can turn 25 cents into $10. And that might be a starting point, because when it's $10, by that time, whatever your wife is telling you not to buy, you won't be able to buy then. That's all. But I think you've got a great position. I congratulate you on 600,000. I'm very jealous, by the way, in a good way, a positive way. But man, awesome, Bob. Awesome. Good job. Ward Richardson. Bob, well done. Welcome to the Mach 6 Club. By the way, Bob, they always say you had enough. I'm glad you did not listen. Exactly. And then he says, rail engine strong. Bob S. Thanks, Ward. Good to be in the club. I think I will cut her out of the loop. I can't believe the price for this. Just be careful. If you cut her out of the loop, she might cut you out of the well, you know. PS71. Hi, PS71. Hello, Sir Bill. PS71. I'm at the Nevada Gold part. I have no more money to put in unless RT. Exactly. It's very difficult. If Railtown had already gone, even if it didn't reach some high numbers, I'd do it myself. I get it. So don't feel pressure. The good news is PS71. I think I'm going to get it done. And even if we don't, I'm going to stay very active and involved. I actually think, and I have been, it's not like it's new, but I think that there's a very strong chance that this group, because of their large previous commitments, are not going to, and it's a bunch of individuals, they're not going to hurt shareholders. But I'd like to keep it. I'd like to keep the alternatives. I'd like to keep it. What's Reagan's word? Trust but verify. I'd like to see that, but if you get a site visit scheduled, let me know. I'll meet you there. I'm sure the investor /S that I would bring would not mind that at all. I think. I don't want to speak for them. But I'd have to get approval from the company. I don't think there'd be a problem with that. I think it's a good idea. T. Alex. Hello, everyone. Grateful to see people adding in a big way. See, I love it here. I love it here. People are not jealous. They're helping each other. And I'm amazed by it. I'm absolutely amazed by it. That's so wonderful. These prices definitely are not here forever. I'm looking forward to adding more myself. Brandon Judkins. Hello, William. Hope you're well. Hi. Hi, hi, hi. Hi, hi, hi. I heard a possible explanation for why Railtown isn't doing their Form 7. It's because they're out of the what's it? I want to say they're out of the penalty box, but I don't want to say they were ever in a penalty, but they're not in they're in a better position. I don't know if it's because they went commercial or because, look at the name. Look at what's on the CSE describing Railtown. I'll read it to you. Railtown AI Technologies is in the business of developing a software as a service artificial intelligence solution that helps software development teams detect, analyze, and fix errors quickly in their development projects, the platform. The platform allows for real-time exception monitoring and alerting, which permits developers, team managers, and executives to quickly locate, understand and correct errors in their software development projects and their root causes, thereby preventing system and application downtimes. That's it. I'm telling you, the automatic screeners are not seeing that. And that's why you're able to build your position. When that changes, you won't have the option of buying at 25 cents. I wonder if you'll have an option of buying at $1. That's how quickly it'll move. So I wouldn't hesitate. And I am fighting, and I agree with Eric. I've probably been counterproductive. And I hear his criticism and I accept it. I'll try to do better, but my meaning has been to be specific because I think that's the best way to identify the risk, but maybe it's better just to be general. And when that changes to say something like Railtown AI, it'll have some of that in it, but then it'll say it sits at the orchestration layer in, I don't know, at TELUS, or it says Railtown sits at the orchestration layer at data centers, blah, 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 blah. Boom. I think it's a $5 stock when that happens. So you can buy 25 cents now, and boom, just changing that, I think it's a $5 stock. But revenue would, suggested revenue would help a lot too. All right, I don't know what else to talk about, so I might sign off unless there's any comments. But PS71, don't worry about that. Don't worry about that. I guess I'm just telling everybody there's an opportunity. I'm not saying that it's a. I don't think it's urgent. I think things are going to be fine. I do think it could have an impact on whether we're capped or whether we have a smaller piece. And I don't want to see that. So, but everything's good. Relationships are good. Cooperation is good. It should be fine. The positive news is, as I connect it, this group who they're the ones that already put $1 million in. But I think their associated people have a lot more in it. And I don't think they are necessarily like a lot of private equity. They're not necessarily, mining guys, but they are good with how to make money, cash flows, risks, all that. And they have extensive ability to bring in knowledge. Like they brought in I know the guy's name, I've never spoken to him, but they brought in a PhD mining engineer and maybe even a professor, but and older. He knows what he's doing. And he went out and studied everything. And then they put the extra $1 million up. But I think what's happened since then is either that guy or other people are testing, have been working on it. And it's my sense, and I'm not positive, but they're ready to go forward completely. They just took a prolonged due diligence, and I've already explained my reasonings for wanting to make sure that we're there. If my original investor had gotten his money, we'd be in control, and it'd already probably be in production. But that just didn't happen. That's the shakes. So we got to adapt. We got to adapt. Yeah, I don't know what else to talk about. So maybe it's a good time at 8:22. No more questions. Nothing. Should we hope beyond hope that there's any news tonight? Let me just look. No news. No news. And it might be there isn't going to be. This week. TELUS was downgraded by Morgan Stanley to underweight. I wouldn't mind getting a copy of that. Others have the higher value. TELUS migrates legacy customers to Ericsson 5G Core with dual mode functionality. Four hours ago, Calkine Media, TELUS builds AI-driven services this week. Let's just see what that says. If I can read it. No, I can't read it. It's behind the wall, so I can't read it. Anyway, all right. I guess that's it. I apologize to you, Eric. I'll do better on that. And hopefully I have something to talk about tomorrow. So I wish you all a good night, and we'll catch each other on the flip side.